Ladies and gentlemen, our program will begin in 10 minutes. Ladies and gentlemen, our program will begin in 5 minutes. Ladies and gentlemen, our program is about to begin. Please welcome to the stage Bennett Richardson, General Manager and Global Head of Public Affairs at Semaphore.
Good morning, everybody. Good morning. Welcome to Day 1, Session 1 of the World Economy Summit. We really appreciate you all being here. I'm Bennett Richardson, General Manager and Global Head of Public Affairs at Semaphore. It's great to see the room so packed and see so many familiar faces. As I'm sure many of you already know, Semaphore launched 2.5 years ago with a simple belief that global journalism should be intelligent and transparent and global and built for a world that is both increasingly interconnected and also increasingly fractured. The global economy and the forces that shape it is obviously today's biggest story, especially true in the past 3 weeks. And we've created this summit to bring together those who are building and leading the future world order. The World Economy Summit is an opportunity for honest, fact-based, transparent, and global dialogue. Over the next 3 days, you'll hear from US cabinet officials, congressional leaders, global finance ministers, central bankers, Fortune 500 CEOs, sovereign wealth fund leaders, and more. This morning, we'll hear from top financial leaders about this moment of profound economic changes and how they're pursuing a path of resilience and growth. First, want to express gratitude to Bank of America for being this morning's founding partner and supporting our live journalism. And we really appreciate you all being here. No better way to kick off the World Economy Summit than with an economist. So please join me in formally kicking off the World Economy Summit and welcoming to the stage Bank of America's Head of Global Economics Research, Claudio Irigoyen. Thank you, Claudio. Let's dive right in. No better place to start than trade and tariffs, given how the world has changed so much over the course of the past 3 weeks. 2 questions on my mind for you. One, how are these escalating trade wars already starting to reshape global supply chains? And where do you see the biggest impact in terms of specific industries or specific regions?
Okay, so it's really a complex question, and the world is getting really complicated. We are discussing themes that probably 5 years ago, 10 years ago, we thought they were settled. I always make the joke that the world is so complicated that Bank of America had to name an Argentine to run global economic research. So to some extent, I come from the future. I know what's going to happen. So the way we think about this is the following. We just downgraded our growth forecast for this year. Global growth will go from 3.1 to 2.7%. We are not calling a recession in the US, but we are calling a slowdown, probably 1.5% growth for this year on average, and quarter over quarter 1%. It's a decent slowdown relative to what we thought maybe 3 months ago. A lot of changes. But the important thing behind that, and we have also downgrade for China and for Europe, etc., and Japan. But the framework to think about the world that I think it's important, and we presented this framework 5 months ago, and it's aging very well, to be honest, is we think that Trump will negotiate his way, in a bumpy way, but he will negotiate country-specific comprehensive packages that will involve trade, defense, energy, immigration. Obviously, the final outcome will be completely different for Canada and Mexico. Probably nothing will happen, obviously, until we have a new government in Canada, but the end of the road, probably you're going to end up with a USMCA agreement that is going to be more robust than the first one. So to some extent, the supply chains within USMCA will be shielded. Negotiations with Europe are going to be a bit bumpier, but eventually will involve defense. It's not independent of the outcome that you have in Russia, Ukraine, because that implies different incentives for Europe to unify or not and decide what to do in terms of defense. The outlook for defense is tricky because Europe wants to have self-sufficiency, and it takes a lot of time to be self-sufficient on defense. So at the beginning, you need to import a lot of weapons and inputs still from the US, which would be probably part of the negotiation at some point. And China is going to be the toughest one. On China, we are under the assumption that we've seen the worst in terms of escalation. In general, we've seen the worst in terms of escalation, so we should see more de-escalation from here. The pace will depend on the relative pain on the economy in China versus the US. If you talk to the Chinese, they will tell you we are infinitely patient. We need to deal with the slowdown of the economy. We need to deal with deflationary pressures. But we don't need to deal with stagflation, and we don't need to deal with elections. So the incentives are different, and that's the way they are approaching the negotiation. We were assuming that probably it's going to take about 3 months to really sit seriously on the table, which is what you need in order to see in the hard data some pain here in the US, and how bad the stagflationary trade-off show up in the US. And then eventually, before the end of the year, you should have something closer to the steady state in terms of how the outlook will look like for the rest of this administration, at least. There will be some trade deals that will come faster than the China one, probably Japan, probably India. India will be a perfect example of a comprehensive trade deal involving defense, energy, and trade. And I think this administration needs to show quick wins.
Absolutely.
So that's where we are.
No, thank you. I wanted to come back to China. You touched on the impacts within the country. How do you think this approach and these policies are going to influence global markets?
Well, China in particular has their own issues, structural issues. They need to rebalance their economy. They have an economy that is still, the private sector saves an insane amount of money. And they need to channel that investment into, or those savings into productive investment. It cannot be back to real estate because it doesn't work. And the Chinese know it and feel that kind of the social contract didn't work because they were sort of induced to save in real estate, and now they had a plummeting in real estate prices, so that's the reason why consumer confidence dropped after COVID and never recovered. So they need to rebalance their economy, and they need to deal with the fact that the excess capacity they have cannot be just dumped into the rest of the world and expect the rest of the world to be happy about it. It doesn't mean that I'm not judging the strategy, but I wouldn't be surprised if the rest of the world, instead of saying, okay, let's do trade agreements with China, say, I'm not sure that we can absorb it, so maybe some tariffs on China are the next backstop. It remains to be seen what happens between the US and China to see what are the spillovers for the rest of the world and what the relationship will be between, in particular, China and Europe.
Makes sense. Thank you. Coming back domestically, I want to touch on the Fed. You know, during the outlook that you all released on Sunday, you were kind of calling on the Fed to not cut interest rates. And would love to just hear more about how you think about the Fed's monetary policy decisions. How do you expect them to navigate this real challenge, right, where it sort of splits their dual mandate, address persistent inflation pressures, but also navigate these risks? You all, like you said, aren't calling for a recession, but you know, as more of a economic slowdown. Like, how do they balance and navigate that?
It's extremely challenging, and extremely challenging to deal also with the market reaction. I mean, Monday was about Trump fighting Powell, and Tuesday was about Trump not fighting Powell. And that creates a lot of volatility. And the way we think about it is in this trade-off, which is a typical emerging market trade-off, Powell has an incentive, or the Fed has an incentive to wait and see. This is, if this is a recession or slowdown, it's not generated by the Fed. It's a confidence shock. And you can put interest rate back to zero, and investment will not pick up until confidence is recovered. And it's not confidence about the Fed or not, it's confidence about the stability of the broad macro backdrop and the policies in the US. So the solution to the slowdown is not the Fed cutting interest rates. But if the Fed cuts interest rates and inflation expectations start to pick up, then there is a problem. And it's not that we are coming from 10 years of sub 1% inflation. We are coming from a period in which inflation was high. The Fed was concerned about probably being too late on hiking interest rates. And inflation expectation this time will be more volatile. And in addition to that, there is a lot of uncertainty about fiscal policy. Just think about the incentives that Congress has to do proper fiscal consolidation if you cut interest rates 300 basis points. And if that's not enough, when you talk to companies, they tell you, well, we try to front run as much as possible the imports, and we are going to smooth out the increase in prices in order not to lose market share. So that will create persistence in inflation. And the Fed will feel very uncomfortable calling for cuts before seeing the peak in inflation. So the Fed has an incentive to wait, see inflation peaking, and then eventually cutting faster than what the market is pricing in, rather than cutting preemptively and then running the risk of de-anchoring inflation expectations.
Got it. You mentioned confidence and that balance of confidence and uncertainty. One area, obviously, that we've had a lot of conversations about confidence is in the dollar. Just a lot of debates going on about de-dollarization, especially over the course of the last several weeks. How do you all assess the future role of the U.S. dollar, obviously as the world's reserve currency? Are there any factors that you think are most likely to either accelerate or hinder any shifts away from the dollar?
Yeah, I think with the dollar, there are a couple of things. First, I think it's important to understand why the dollar is weakening. And then we can talk about the role of the dollar as a reserve currency and whether there is a real threat to the dollar in the near future. The dollar is weakening because there was a massive overweight on US assets, equities, bonds, even the currency, before this confidence shock took place. So this confidence shock is not just about increasing tariffs, it's about increasing tariffs in the morning, suspending them in the afternoon. So that creates a lot of volatility. And obviously fighting power, not fighting power, fiscal policy, etc. So when that happened, markets reduce risk. And when you reduce risk, volatility spike up, so you need to reduce the notionals in order to keep risk under control. When that happened, you sell what you were long and you buy what you were short. It happens to be that this time people were long the dollar, not short the dollar. People tend to think that in a safe asset currency, you move to that currency when you have risk off. Well, that used to be the case when the dollar was a funding currency because interest rates were low in the US. Now it was the currency that people were long to play those carry trades. We're long the dollar and short the Swiss franc, the yen, etc. So when you had this shock, the yen appreciated, the Swiss franc appreciated, gold appreciated, and the dollar sold off. This is the immediate market reaction. The more medium-term story is that if you don't offer stable rules of the game, capital will flow somewhere else. Now, the question is, somewhere else where? Is Europe a better story? I doubt it. Is China a better story? I doubt it. So we are just seeing the initial reaction. If we see some de-escalation and more stable rules of the game in the US, those flows will stabilize. Now, in terms of the dollars as a reserve currency, the dollar used to be 66% of global reserves, now it's 54%. 8, it still cannot compare to the next one in the line, which is the euro. The renminbi is an interesting story because it's just 4% of global payments. The dollar is 47, but the renminbi was 2% 3 years ago. So it's picking up in regional trade. So for instance, India is buying oil from Russia and settling renminbi. So that story will continue. There will be more internationalization of the renminbi, but it's going to be more for regional trade. So long story short, I think the dollar will weaken. We expect the dollar to weaken more from here for the wrong reasons. But that doesn't mean that the reserve currency of the world's status is going to change anytime soon. There is one thing that is important. There has been an acceleration of the diversification away from the dollar into gold, particularly into gold, but gold, euro, Swiss franc, when the US imposed sanctions on Russia. Because the safe asset nature of the treasuries changed when the US imposed sanctions on Russia. So many central banks strategically, for geopolitical reasons, started to sell treasuries and buy gold. That will continue over time, but I don't think the dollar there's any real threat to the dollar in the coming future. Now, you keep pushing with bad policies, and obviously, then you're going to get in trouble.
Definitely. Let's try and end on an optimistic note.
Okay. That was my bullish speech.
That was the bullish, perfect.
Yeah.
But no, curious, I mean, obviously we're here with so many countries represented, so many CEOs represented. Would love to hear from you as we look for growth opportunities around the world. What countries are best positioned for growth in this new emerging global economic order? And how do you think these leaders should be thinking about navigating this new moment?
I think this idea of, first of all, you need to understand why Trump is imposing those tariffs. And that's a very difficult question to answer, because is it about revenues? Is it about reshoring of manufacturing? Is it about negotiating to have actually more free trade? Hard to tell. But companies need to stop thinking about changing the mindset, stop thinking about producing what is cheapest to produce based on efficiency, and start producing what is safer to produce. And safer means that you have to produce with and allocate your supply chains within the geopolitically friendly blocks that you're going to do business over the next 5-10 years. And there are tectonic shifts in geopolitics. Everything is changing as we speak, and that's the most important question that you need to answer. And in that sense, probably I'm not very optimistic that you're going to have a lot of reshoring into the US, but I think there will be more friendshoring into places like Mexico, India, Brazil, Costa Rica. People want to stay away from the big trouble, which is the US or China. But obviously, everything depends on how those deals or trade negotiations evolve in the next 6 to 9 months.
There you go. Well, thank you so much for providing us such a fascinating kickoff to today's conversation. Really appreciate you being here. All right. Thank you all.
Please welcome Eric Lombard, Minister of the Economy, Finance, and Industrial and Digital Sovereignty, France, and Hadley Gamble, contributor at Semaphore Gulf.
Good morning, everybody. Once again, welcome to the World Economy Summit. My name is Hadley Gamble, and I'm thrilled to be sitting next to the gentleman beside me. Your Excellency, I know that you've prepared some remarks. Give us a sense of the future of U.S.-French relations.
Yes, thank you very much. I'm very glad to be with you today. And as you can imagine, the main topic of discussion this week is the future of global trading system. Maybe you are interested in it. And starting with that, you may be surprised, but I agree with the analysis of the current US administration. global imbalances must be addressed, including those stemming from non-market practices that distort competition and fuel overcapacities. I wanted to start with that. And to overcome those challenges, dialogue is the best way forward. And regarding the relationship between the European Union, EU, and the US, let me recall some facts. First of all, the EU-US bilateral trade flow is the largest in the world. It has doubled over the last decade. When it comes to services, the US enjoy a very sizable surplus with the EU, thanks to highly innovative American tech sectors that we all know. And as a result, despite what you may hear, when both goods and services are counted, transatlantic trade is almost balanced. For we, Europeans, this is a foundation of shared prosperity and economic security, but also an alliance and friendship that has lasted for generations. EU companies are the largest foreign investors in the United States, with total foreign direct investment stock of 2.6 trillion. We bring capital, jobs, and technology. So, let me say that very simply, we deeply regret the American decision to increase custom duties on imports, including all imports from Europe. It will penalize consumers, businesses, and growth abroad, but also and primarily in the US. The European Union is seeking a negotiated solution, an agreement that would be a win-win for both parties. Nonetheless, the EU is working on targeted and measured response in case we cannot reach a deal rapidly. But let me insist, we very much hope to avoid such actions by reaching an agreement with the US. So let me summarize. I'd like, above all, to send a message of friendship and resolute optimism to our American friends and allies. I'm convinced that the current period of turbulence is worrying but temporary, and the relationship between the US and France, between the US and Europe, has been marked by occasional episodes of misunderstanding and sometimes tension, and we have always overcome them. There are no continents closer economically, politically, or culturally than Europe and America. We share common history, common foundations, common democratic principles, and a common vision of freedom and progress. Our continents have demonstrated unwavering solidarity in difficult times. And let me say that sincerely, France and Europe will forever be grateful for the support given by the United States in the time of great distress in the 20th century. But we have also fought alongside with you when you needed us, and we still do. Today, more than ever, our two continents face common challenges. We'll be stronger if we tackle these together. Division will get us nowhere. So I'm calling today for a new partnership between Europe and the US for growth, for sovereignty and security. And this partnership, I will end with that, can be built on three pillars: greater commercial fluidity with the horizon of a genuine free trade agreement between the US and Europe, reciprocal investment of our abundant savings on both sides of the Atlantic to support growth and employment, and the defense of the rule of law, social justice, sustainable development as cornerstones of our social contracts. I hope that the flourishing of our economies and trade will serve not only for its own sake, but also to support the principle of liberty that founded both the United States and the European Union. And I'm ready to take questions or remarks. Thank you very much.
Thank you so much for that, Your Excellency. So essentially what you're saying is that reports that the Statue of Liberty may be taken back are overblown. We can keep her? Can we keep her?
It has been a gift.
Gift! So from the remarks, essentially what you're saying is you want to get a deal with the president.
Of course.
Walk me through this then, because just a few days ago you said that the removal of Jerome Powell would be catastrophic for the US economy, catastrophic for the US dollar. What did you mean by that?
You know what Nixon said? He said that the US dollar was our currency and your problem. He says that to the Americans. So the US dollar is your currency and we don't want it to be our problem. And when we have seen the market turmoil in the last few days, especially on the fixed income market, that's not a problem for the US, it's a problem for the world. Yeah. And so the US remains the anchor currency of the global economy. And it is important, and we are part of that system, so that was my only remark. And I've seen that President Trump concur.
Your predecessor suggested that the EU, or rather the euro, could become another global reserve currency. Do you see that happening?
The leading anchor currency is US dollar, and I believe it is important that it stays like that. Euro can be an alternative, and there are more and more foreign reserves denominated in euro, but the euro is not challenging the US dollar. I mean, I think the current balance is a good balance for the global economy. It has helped us to develop trade, to develop growth. So stability is important for us.
Talk to me a little bit about some of the issues that you face closer to home. You have an enormous budget deficit and you've got the highest tax rate amongst your European colleagues. Where are you going to cut? Because you got to.
When you speak, when I met my opposite number, Scott Bessent, we share many things, and what we share is the same budget issues. The US deficit last year was 7%, in France it was 5.8%, and with both target 3% with different method. We have a high tax rate, it's right, but it went down to where it was in 2012. So we brought it down since Emmanuel Macron is president, and will continue to cut taxes. The budget will not increase taxes for corporate or for people. And what we do, we just maintain expense flat. And if we do that, and we are going to do that, we will bring back deficit to 3%. We will stabilize debt, and that will allow us to have an agenda of economic growth, cutting red tape, developing business, and we have to catch up with the growth of especially the United States. And the agenda of the European Union with Ursula von der Leyen is an agenda of competitiveness, growth. And by the way, I know that you want us to invest in the US. We do, as I said, but welcome also to invest in Europe. That will be a land of growth in the coming years.
But there must be somewhere, when you look at the budget, where you were prepared to cut. If you could pick anything, and you can.
If you compare the budget of, let's say, France and the US, then for the US, you should include the cost of health and the cost of pensions. In France, it is in the budget, it is paid by taxes. In the US, it is paid by the people. It's a huge difference. And the cost of health in the US, as a proportion of GDP, is 50% higher than in France. So we believe our system, which is true, is a lot of it is in the hands of public interest, health, pensions, family policies, but it's working well if we can balance it, and it allows us to have the level of growth and wealth that we have. I totally agree, it has to be improved. We are working on it.
So you're open to cutting the budget?
And cutting the budget, we have to cut the budget in real terms. But again, if you look at what we have to do, let's take defense. The United States rightly said to us, you have to take care of your own defense. That's right. Macron has been saying that in the last 7 years. We have to finance that. So within the same level of expense, we have to increase the share of defense. And so we have to cut the rest proportionally. And we believe we can do that, and we will do that.
I want to ask you about the nuclear deterrent. There are a lot of questions about if the United States is not defending Europe, how will Europe defend itself? You obviously have a nuclear deterrent. Are you prepared to charge your EU partners for that defense? It only seems fair.
What we have seen in the last decades is nuclear deterrence does not prevent war, unfortunately. We have a war in Europe between a country having the nuclear weapon, Russia, and a country which does not. So the first way to make sure we are in safety in the coming decades is to have a strong conventional defense, and that's where we will invest. And that will be the priority. Because
But France can't fund that alone. I mean, what I'm asking is, would you expect that your European partners pay a fair share of that defense?
We are not there yet at all. Again, our priority is to build a conventional defense because we believe that that will be the rule of the game in the next decades. There are demands of our partners to discuss on nuclear defense. That's the responsibility of the president.
So you're not ruling it out, though?
I don't take that point which relates exclusively to the president.
Tell me this, there's a deal being worked on between the EU and the UK, your partners. The reports have said that officials on both sides are denying this has anything to do with fishing rights. If it isn't fishing rights, what's the problem?
We have to settle the consequences of Brexit. What is happening in the world today, and again, I made a call to strengthen the relationship between the US and the EU, but it's clear that our British friends want to get closer again to the Union. My opposite number, Rachel Reeves, attended to the closing dinner of the summit of European Ministers of Finance. I can share a secret with you, there's no media. We are talking
You kept this out.
about every week together on various issues, and that's great. Because even if Great Britain is not part anymore to European Union, they are still in Europe. And especially when it gets to defense, but not only, we have a lot of common interest and we are dealing with it. And it's true that we came closer in the last couple of months, and that's fine.
We've still got a timeline. When do you anticipate that deal getting done?
With the Americans? Well, the sooner the better. I have a number of exchanges. As you know, the negotiation is led by Maroš Šefčovič for the Commission, but various countries are contributing to it. We are ready to deal anytime.
Your Excellency, thank you so much for joining us.
Thank you to you.
Please welcome Hirofumi Asuka, CEO of SMBC Americas, with Andrew Edgecliffe Johnson, CEO Editor at Semaphore.
Otsuka-san, I'm delighted that you can join us here at the World Economy Summit. You're CEO of SMBC Americas, which is the unit of Sumitomo Mitsui Banking Corporation that stretches, I believe, from Canada to Chile. Importantly, includes this rather eventful market we're sitting in now. SMBC itself is a $90 billion institution with very deep roots into the Japanese economy. So I'm very keen to dive into this, our subject here of Japan's economic rebirth. Before I do, I have to ask, with Japan among the countries now trying to negotiate a trade deal to soften the blow of US tariffs, how dependent is that rebirth on what happens here in Washington?
Yes, well, I think the short answer is that for Japan, we're very highly dependent on how U.S. performs. And if you look at the history of the relationship and the ties in various areas, this is a very easy answer. First, there's a strong economic ties in terms of investments, financial ties. Japan is the largest U.S. government bond holder. Japan is the largest foreign direct investor into the U.S. market. And on top of that, you have the national security agreement with the United States. So all in all, it's inseparable. It's a very important market for the Japanese.
I mean, we've heard the Japanese Prime Minister express grave concern about the tariffs. We had the Japanese chief trade negotiator in Washington last week, but leaving without a deal. You know, from what you're hearing from your clients, from your contacts in Japan, are you hopeful that there will be a deal that does soften that blow?
Yes. Well, first of all, we're very optimistic of the outcome. I think you can see that from the fact that Japan is the front runner for the negotiation. I do believe that there's mutual understanding on the both sides that you really want to, get this deal done, and kind of put that as a good example as other negotiations take place. So in that sense, I think there's a lot of positive vibe, as much as how it's told on the press. I think in reality, there's a lot of positive vibe within the negotiation.
Okay.
So I'm very positive.
So let's pull back from that uncertainty and look at what you're seeing in the Japanese economy itself. What changes do you see happening right now that give you confidence that this is the right time to be talking about an economic rebirth for Japan?
So for someone that started their career in the late 80s, so I started banking in the late 80s. So I basically worked at the bank through the last 30 years of deflation. So if you look at my salary, and if you incorporate the real interest rates, my salary hasn't gone up for 30 years. So when you take that perspective, I think what you're starting to see in Japan is a very positive. Inflation is good in a way in Japan. You're starting to see a lot of positivity in terms of growth, interest rates, and the fact that wages are starting to go up. But moreover, I think what you're starting to see is that Japan is finally becoming more up to global standards in terms of corporate governance. It is attracting more foreign investments into the country, and that itself is putting more opportunities for growth.
And obviously the big sort of macro question on Japan has been one of whether it can combat deflation. Japan's finance minister just a few weeks ago was sending quite a cautious note on this. We have, seen some inflation in Japan, but he was saying that was driven largely by a weak yen and by high commodity costs, rather than by rising wages for bankers and others, or by consumer demand. Do you think more needs to be done to stimulate domestic
Yes,
demand?
I think there's two challenges. One, I wouldn't say challenges, but one is that wage needs to go up. If you look at the corporate performance, the Japanese corporate performance, they're performing very well. So if wages go up in line with the inflations, that will push more consumptions in Japan, and that will try to create more positive, a momentum within the economy. Right. So that's one of the things that we need to overcome in terms of raising wages. So again, not to advertise, but I think SMBC recently announced for newly graduate students, they increased monthly salary of I think close to 20% increase on the monthly salary increase in order to be a good example of how wages should go up. So that's one thing that we need to overcome. The other is the declining population. So in the longer term, there are investors that question Japan as a market, given that the population is declining and it's a mature market. So for Japan, I think one of the things they need to pursue more is more participation from females. So Japan still have challenges in promoting more females coming into the workforce. They're probably somewhere around 50% in terms of participation rate, so that needs to go up to 70, 75%. So that's one. They need to open up more opportunities for elderly. Japan historically has been more attuned to what we call class, meaning the years of working at an institution do matter, and they kind of push you out once you're 60. I think they need to open up more participation for elderly. So if you come over those two, you will be able to kind of fill in the gaps in terms of the declining population.
So just looking at the sort of interplay with the markets here, we've seen Japanese retail investors start to push more of their household savings into the stock market recently. What opportunities do you think this is going to open up, and do you see that trend continuing?
Yes. I would say that for the retail investors, historically has been putting money in bank deposits, and they don't really invest. So that was another challenge for the financial markets in Japan. The Japanese government has been strongly pushing for retail investors, retail depositors to invest more. And they have created a tax-exempt account called NISA, and that has been very successful up to date. For ones that have been shifting their deposits into investors, I would say half of them has been reinvested into U.S. stocks and bonds. So there are a lot of opportunities for the U.S. market or U.S. financial markets to capture that money moving from deposits into investments.
Japan's been the biggest international
Yes.
holder of U.S. treasuries,
Yes.
hasn't it, with a $1 trillion stockpile. Do you think the recent weakness in the U.S. bond market, or volatility at least in the bond market, has changed Japan's appetite for those U.S. assets?
I think people would look at things in a longer term. So as much as people might be a bit anxious in the shorter term, the long term, I don't think the sentiment will change dramatically.
Okay. So how open right now do you think Japan is to international investment, to M&A? We've seen U.S. companies attempting acquisitions in Japan. Do you think we're about to see a more open environment for M&A in Japan right now?
Yes. From the perspective of banks like us, we do see more opportunities coming up in terms of financing foreign investors actually acquiring Japanese businesses. I think the most active players in the market today is private equity. So, all the big names that you would normally hear in the U.S. market are very active in the Japanese market. And I can't imagine major ones not having a presence in Japan today. So that's one big player. For certain industries, I do see there's more investments coming in, whether it's things like pharmaceutical, just taken as an example. I do see more activities for foreign investments coming in. So overall, I think you're going to continue to see more active investment into the Japanese market or Japanese corporates.
What about M&A in the other direction? We've seen Nippon Steel still attempting to buy US Steel. Just this week we saw Nomura buying Macquarie's US and European public asset management business. Particularly with the dollar weakening against the yen, do you think we could see more Japanese activity coming into the US market?
Yes, I think the exchange rates will play an important role in terms of investors in Japan determining the timing of the investment into the U.S. But putting that aside, just going back to the first question you were asking me, for most of the Japanese corporates, U.S. market is a market very difficult to ignore. They look at the market in the longer term, and they continue to be a top priority focus for them. And as you can see on the data, the Japanese companies have historically been the largest investor in the U.S. market. So I don't think that will change, and it will continue.
Yeah. So you've made the case for why you do believe there's a Japanese economic rebirth. What do you think are the hurdles still in the path of that rebirth? What structural reforms do you think are still needed to achieve it?
Yeah. So I think the improvement in corporate governance will need to continue to evolve. I think it's in a very good track for that. Also, from my perspective, I think the market has improved quite a bit, but I think it needs to be more foreign investor friendly. Just starting with languages and also regulations and laws that are not exactly standard. I know there has been some discussions around that with the U.S.-Japan trade negotiations, but if I would generalize, there are many regulations that can be improved or enhanced in order for foreign investors to come in more smoothly.
So let's end on a question about SMBC's US strategy. You've found considerable growth in recent years. You were recently designated a primary dealer by the New York Fed. Where are you finding a gap in this market?
Gap meaning?
Where's your opportunity in the US market?
Yes. So for us, we've been operating in the US market for over 100 years. Historically, our business has been commercial lending. We started off with supporting Japanese major companies coming into the US market, helping them get working capital or foreign exchange. But over time, that has evolved into a more local business. So today, as much as it's not a household name, our business is over 90% US business. So we're no different than JP Morgan or Bank of America in terms of the business we do. I think the bigger opportunities for us is businesses beyond the traditional commercial lending, which is investment banking. It can be capital markets, M&A, global markets, trading, treasury bonds,
right,
or U.S. equities or whatsoever. And that kind of goes back to the fact that we have a strong foothold in Japan, and there are many Japanese investors that would like to have access to the U.S. market.
All right. Well, on that note, I'd like to thank you, Hiro, for
Thank
joining
you.
us. And I wish your graduates better luck in their salary progression.
Thank you. Thank you.
Please welcome Ted Sarandos, co-CEO of Netflix, and Ben Smith, co-founder and editor-in-chief of Semaphore.
Squishier than you expected.
Yeah, I know, we both kind of. Well, thank you all for coming. Thanks for joining us, Ted. And I guess to begin with, we're in Washington. What we care about in Washington right now is factories that make stuff. The economy is, there's a sense in the White House that the thing they care about is manufacturing. You are, and you never hear about the trade surplus in services like streaming.
Yeah.
Do you feel like the entertainment industry gets a bad rap here? That nobody takes you seriously?
Yeah, I don't know if it's a bad rap, but it certainly gets overlooked as an industry. I think it's easy to forget, but Netflix alone, I think about from 2020 through 2024, contributed $125 billion to the U.S. economy, created 140,000 production jobs, 500 productions. We have shot films or television in all 50 states. It's the lion's share of our investment is in the U.S. So we have 9,000 employees and 3 million feet of studio and 2 million feet of office space, primarily in California. But I do think it gets overlooked as an industry. So we get kind of thrown under the bus in trade deals occasionally. People forget that this is a real business. So
Yeah, do you think this administration...
you hardly ever see a sitting president photographed on a studio lot. And
you would think this one would be into it.
Yeah, you'd think, I'm not sure. I was thinking about it like when we went to Mexico, we announced a $1 billion investment in production in Mexico with the president on her morning press conference. And I was thinking if we were building a plant to build $1 billion worth of cars there, the president would certainly announce that. So it's very exciting.
Yeah, do you think this administration specifically is getting it wrong? On services broadly? I mean, do you think, like, maybe young Americans are more interested in growing up to be production assistants and set builders than they are factories? Is that?
I think it's feasible that there's an evolution in the culture around the way people want to work and how they work, what they value, that is more aligned with what you're talking about.
The other big theme of Washington right now is deglobalization.
Yeah.
In cultural kind of deglobalization too. You guys are going right in the opposite direction. Netflix is an incredibly global company. I think Squid Game was the most watched global production ever of anything. How do you think about navigating those streams?
The way that we are at the same time a tech company and an entertainment company, we are a local company and a global company, wherever, depending on where you're sitting. So our Korean team feels very much like it's a Korean company. They're able to make great programming like that for Korea because there's no focus on making it global. In fact, there's no discussion about making anything from a local country global. If you look at right now our current enormous success with Adolescent, it is a remarkably British show.
And maybe people should. Do you want to just tell people? This is I literally lost sleep last night watching it. I don't know if people are watching.
Did his homework.
Incredibly disturbing show about a 13-year-old boy who commits a horrible crime. That's all filmed in one take.
Four 1-hour episodes, all shot in one take, and it's Jack Thorne and Stephen Graham created it, and it's a remarkable feat in technical storytelling, but also, as you saw, it's an incredible story and incredibly active. And it's very much in driving the discussion in the UK right now.
Yeah, and you saw, I don't know if people saw this, there was the conservative leader, Kimmy Badenoch, did an interview where the interviewer was incredulous she hadn't seen it and started asking her, how could you not have watched this?
Yeah,
what was your reaction to that?
I've never seen anyone get shamed for not watching a TV show so much. It was.
Do you think she should? I mean, do you think it was appropriate that she should be ashamed?
Well, the thing that she was talking about is of such great interest, and I guess I rotate towards, I get so much information and context and color around a story from TV and film, and the fact that everyone in the country is talking about it.
She said she was too busy to watch TV. Is that an acceptable excuse in this day and age?
I don't believe anyone who says that.
But I do want to talk a little more about that show, because I assume that's being watched outside Britain now as well. Is it hitting globally?
It's an enormous success all over the world, like I said, and it's extremely British. It's the very first show in the UK that we've made. In fact, it's the first streaming show that topped the ratings in the UK. So just like everywhere else in the world, the UK has been incredibly slow to the migration from broadcast and linear television to streaming. But this is the first show that topped the ratings, beat the BBC, beat all the broadcast shows. And it's a big hit around the world. And the thing about it, like I said, it's so British that most of you will probably watch it with subtitles, even though it is in English.
But it's specifically about a young boy who is kind of radicalized online into a kind of misogyny and violence.
It's a very of-the-moment story. I mean, I think that's what people are excited about. And I do think you come into it from so many different ways. As a parent, it's a very difficult watch. I think as a film lover or a television lover, you're going to love the way they made it. The performances are off the charts. And it's just, like I said, it's something completely different that probably would have never got made under normal conditions of television.
Do you, I think I said this earlier, but like it's most fun sometimes to talk to you as a programmer rather than as an executive, because that is how you came up, and I know what you think about a lot. Are there lessons, really specifically around the themes of that show, which are honestly like very hard to get your arm, I think as a creator, like that's a very challenging, tough subject. Do you feel like will we see more of that? Is there other stuff that you?
I think, honestly, every time you push the boundaries of storytelling a little bit, it inspires everyone else to step up a little bit more and not soften the edges of the story.
To switch to your role as an executive.
It was very short-lived, that discussion.
I was opening it up. I would talk about adolescence all day. That's an incredible show.
But the one thing about it, though, that what makes it consistent with everything we're doing around the world is those teams. What's unique, I think, about the company, what's unique about what we're doing, is the teams there have absolute autonomy around what they program for the country.
And when you see that, do you say, oh, like this will be good in England and maybe it'll hit elsewhere?
Yeah,
is that part of your calculation?
Yeah, it's a bit of a windfall. Like you mentioned Squid Game earlier. Squid Game was made for Korea. By Korean television standards, it was quite expensive, but was not the defense of it wasn't, oh, it's going to get watched everywhere, because that was absolutely nobody.
Did that thought cross your mind when you first saw it?
No, not at all. not at all. I mean, we knew that we had big K-drama audiences and, you know, in pockets all around the country and around the world. But the truth was, this was something that was very different than typical K. It was not romantic for sure. It certainly wasn't
It was very
a
strange
tearjerker.
show.
It was a very straight, but very, very Korean.
Yeah.
So if you're into, which, you know, I'm a fan of like Bong Joon-ho and those early horror,
Right, it was
Korean
like-
horror.
It was like Parasite, but fun. I don't know. I mean,
Yeah,
I don't even know
yeah.
what the pitch for that
No, but
is.
that's the tone. That is a very consistent tone in Japanese
Yeah.
horror, or in Korean horror. So I do feel like there's an opportunity there to do the thing that is authentically correct. The thing that travels the best is not the thing that is the softest version of it. It's actually the hardest version of it.
So in a way, there's
that
no
travels.
such thing as global TV. Global
No,
cinema,
you-
the good stuff is the most rooted in a way?
100%. The more authentically local it is, the more likely it is to travel.
Huh, I think that's
Yeah.
an interesting spin on globalization, deglobalization.
Yeah, because I think people see that, and they see and watch a movie that, you know, where they put somebody from India and someone from Mexico. So it's like, I don't ever see that in the world. You know, people
Yeah.
that aren't even speaking the same language to each other. So we tried that. We had a so-called Sense8 that was like that. And in our earliest
Like
days.
it was meant to tap a quote-unquote global audience?
It was kind of engineered to be that, and
Interesting.
it was actually the shortcoming. It was actually the failure of the show was that. If everyone would have been, when they were in Germany, they should have been speaking German. You know?
Right. Oh, that's so interesting. You've talked about Netflix becoming $1 trillion company. Netflix is in fact up this year. The stock's at an all-time high. Not true of a lot of companies. Still a long way to $1 trillion. We were trying to do the math. Like you sell a $10, $8 subscription to like every single American and a lot of other people, and maybe you get to 1 billion subs, and maybe you're a $1 trillion company. But I think we sort of concluded you got to start getting into some other businesses. Do you open theme parks?
Yeah.
Like,
Well,
how
just
do you
to be
get
clear,
there?
the $1 trillion is a long-term ambition. It's not a guidance or anything.
Oh, for
like
sure.
that.
Oh, yes.
So,
yeah, sorry. Do not trade on this.
Yeah.
No,
But
but
I'm saying,
seriously,
look,
like, are there just to focus the question? That can't just be a streaming business. What's the next business Netflix goes into?
The things that just the parts that we do,
Yeah.
is $650 billion in consumer spending. We're about 5% of that now. We are about 10% of total TV watching time in our most penetrated, most mature markets. So enormous room to grow
Sure,
in
yeah.
just in the things that we do. In the previous 5 years, we doubled our revenue, we grew profits 10 times, and we grew our market cap 3 times. So there's a path to it, obviously. But it all is incredibly dependent on executing well.
But
We
I
could not
guess-
have done that if we didn't execute well.
But so do you then sort of reject that thesis that to get to that kind of scale, you're going to have to find theme parks or, I don't know, some other business, not just a linear growth?
Yeah, I'd say in the core businesses that we're in, there is a linear growth path. Not to say that we won't be more adventurous in what we look at as we get bigger and broader, but like last night, we opened a show on Broadway, which is part Broadway show, part thrill ride. It's the origin story of Stranger Things, called Stranger Things First Shadow. It's an unbelievable experience. So when you see it, your head fills with possibilities of the power and the passion that people have for the IP, and how do you connect with people in different ways.
You say Stranger Things is the most developed, most valuable IP you guys have ever created?
The most developed for sure. We'll wrap up the next season. Will be the wrap of the show. It'll be 10 years. It has got an enormous consumer products line. We sell Surfer Boy Pizza, and Walmart is the #1 frozen pizza brand in Walmart.
Okay, so that's, maybe
there's
that's
there's a lot of those things.
Is that the path to $1 trillion?
We invest in all those things to really build on the fandom and to deepen the fandom with consumers.
Yeah.
People want to express their fandom for things.
So a lot of that is basically, I mean, the Broadway
It's
is
mostly
marketing
It's
rather
mostly marketing,
than a sort of new business.
Yeah, consumer product businesses tend to be fairly low margin, but in scale, it's real revenue. But I do think it's the main one though is that it drives the marketing of the brand and the association and the relationship with the storytelling.
What else is sort of in that pipeline for you in terms of IP? I mean, Squid Game, obviously, right?
Yeah, Squid Game will outlive itself for sure. So right now we've got the Squid Game experience.
Who wants that?
They're sold out. They're sold
It's
out.
in Times
everywhere.
Square, right?
It is.
I've
sold,
walked by
it's
that.
sold
like
out every day.
Like you cross the street to.
Yeah.
I mean, I would like second prize. Yes, first prize, no Squid Game experience.
People love it, and it travels all over the world. And we are opening our first 2 called Netflix House, which is very large permanent structures, and one in Philadelphia, one in Dallas, that is going to be like dining, obviously, some experiential retail, and ticketed experiences that will rotate around. Kind of not a theme park for sure.
Is that a baby step toward a theme park?
Or it's the next generation of what a theme park might be, which is, I look at things like Top Golf and the way that people go and have they'll go 4 or 5 times a year, bring their family and go 4 or 5 times a year, versus something you do once every 5 years. And it's much more fluid and changes.
So subscription theme parks.
But it'll be those things that we've been proving around the world is traveling these experiences like the Bridgerton Ball, which would you rather go to, the Squid Game Challenge
Yeah,
or the
I'll take
Bridgerton
the Bridgerton
Ball?
one.
There you go.
Thank you.
Okay. So, and this is basically people go. We've had at least 7 that we know of marriage proposals at Bridgerton Balls, but fans come in costume at their own expense and their own time, and go to this 4-hour experience of experiencing the Bridgerton Ball.
Yeah.
And it's really cool. And I think people, just like I said, there's a very unique relationship with IP and storytelling, and people who express who they are through the shows that they love.
Do you, Disney obviously.
So this is basically the Netflix houses will bring scale to that traveling operation.
Yeah, I mean, so as I think about this, Disney obviously has created and pioneered that business, but there's also a sense of like, well, I know what a Disney movie is. I know what a Disney character is.
We went the opposite.
It's pretty circumscribed, and so I know when I'm going to Disney World, it's sort of like Disney is a brand that stands for kind of family-friendly and certain kind of entertainment. I don't think. Do you want Netflix to become a brand that stands for a kind of entertainment?
No, in fact, our brand is personalization. So
right, so Netflix.
Your favorite
so why would I go
shows-
to Netflix House? Like I might run into Kill Tony or Dave Chappelle. I don't know.
You probably won't hate this. Just like when
Right.
it's on the site, you probably don't see it much. When you go there, you go specifically to do your.
There are many doors in Netflix
Yeah,
House.
that's right. That's right. You come into whatever the
A house with many rooms.
The entrance you choose. But like, just as an example, Monday in Las Vegas, we had
Yeah.
Monday Night Raw. It was the day after WrestleMania. So we had a brunch at the Netflix restaurant at the MGM Hotel called Netflix Bites. And we had live chamber music from Bridgerton at the wrestling brunch. And that's the interesting thing.
Crazy. Like this sounds like a crazy theme park.
Yeah,
I don't know.
yeah. I hope so.
How close did you guys come to going into China? Can you talk about the thinking back then?
Yeah, no,
15 years ago?
15 years ago, everyone thought it was existential. So you had to get to China. And for us, it's like I put in a couple of years of trying to do it.
What did that mean, going back and forth, meeting with their sort of censorship
meetings.
board, whatever it is?
Yeah, so we actually had a deal with a company called iQIYI to license our content to them because we can't operate in China. You have to have a license, and it's licensed by the government, and they actually will block you onto the internet. So we're a pure play Western media company. There's not direct to consumer. This is not what China really is looking for. But we did this deal, and then the one part of the deal was the content had to clear the censorship board to make it to the air. Mm-hmm. And in 3 years, not a single episode of a single Netflix show cleared the censorship board.
Not one.
Not one. Not one.
So what did you take? So did you then just walk away?
Yeah, they have no interest. They had no interest in us being in China. So for me, I watched everybody spend the next decade grinding out all of their time to get there, and ultimately ended up in the same place I did, which is nowhere.
It wasn't. I think it was not a
Even
huge.
Chinese box office, even they
Yeah,
pennies
so-
on the dollar from
And I think it wasn't a huge cost to your competitors, but maybe it was a big time suck. Do you think it was?
I
do you
think
that was a big mistake. For
Yeah,
those
because
companies?
there had to be opportunity costs in that decade spent chasing.
Yeah.
Yeah.
Are you relieved you didn't know?
Yeah, I mean, we're one of the rare companies in the U.S. that has no exposure to China. I mean, no exposure to China censorship, Chinese taxes, Chinese tariffs, Chinese anything. And there's a big business that in the rest of the world that is happy to host Netflix. Yeah.
Well, thank you for taking the time today.
Thanks.
All right.
Thank you.
Please welcome David Schwimmer, CEO of the London Stock Exchange Group, and Andrew Edgecliffe-Johnson, CEO Editor at Semaphore.
Thank you very much.
David, we're delighted to have you here. I have to start with the obvious question. The London Stock Exchange is 75% of your company name. It's not 75% of what you do. What's the CEO of LSEG doing at a session called the Data Imperative?
Well, Andrew, thank you for having me here. London Stock Exchange Group, yes, people of course think of the London Stock Exchange as a great part of our business. It's been around for 300 years, one of the world's iconic financial brands, and yes, it's about 3% of our revenues. Most of what we do is data. We're one of the world's leading providers of financial data and analytics. Our core data and analytics business is about 50% of our revenue. And then we also have the FTSE Russell Index business. We also have what we call a risk intelligence business, all of which are basically data businesses and analytics businesses. And then we do have equity trading, fixed income trading, FX trading, and probably the world's most systemic clearinghouse. So financial markets infrastructure and data.
All right, we've established your data bona fides. Before we get into that data story, we last met 3 months ago in Davos when you told me that your scenario planning for 2025 presumed a lot of volatility. This is a man who got the Davos non-consensus right. How has what you've seen in the past 3 months changed what you're expecting in the financial markets part of the business for the rest of the year?
Well, it hasn't changed it a lot, actually. And when we spoke a few months ago, I think I talked about the fact that we're not in the prediction business, we're in the scenario planning business. And we do that, our business is global, so we look at situations, risks, opportunities all over the world, across asset classes, across markets. And I think if you look today at the global situation, you have a lot of the same issues and a lot of the same risks that we could have talked about 3 months ago. A number of them have played out in a way that was very different from, I'll say, the consensus in January. But they're, I think, in the context of all of the geopolitical activity, in the context of the discussions around tariffs, in the context of inflation, in the context of the bond market. We look at all of those different levers and many, many more, and we never get it completely right, but it's helpful to try to be prepared for what could be coming.
Are you having to entertain scenarios now that you weren't 3 months ago?
Yes, I think the range of the possible has broadened.
What sort of thing are you now?
Well, there was an interesting article in one of the risk publications the other day talking about the fact that European banks do 17% of their funding in dollars. And raising the question as to whether, if there is an escalation of tensions between, for example, the EU and the US, does it become problematic in some way for EU financial institutions to lend money in dollars?
Right.
That's not something that we thought about a few months ago. So again, I'm certainly not predicting that. That's in that long tail. But things like that are now on the radar screen that I think our industry needs to think about.
So getting back to the data theme, you came into LSEG in 2018. Mm-hmm. What was the data opportunity you saw within it?
Well, at that point, LSEG was a largely European-focused, equities-focused market infrastructure, mostly the exchange, and had a very niche data business, very small, largely focused on fixed income analytics. And the view that we had was the role of data in financial markets is just as important an element of market infrastructure, if I can use that phrase, as is access to the liquidity on an exchange or the risk management in a clearinghouse or any of the other structural elements of the financial sector. Having access to the data and the data itself, you cannot participate in the markets without that. So the vision was to make sure that we were not a niche player in this space, but one of the world's leading providers of data and analytics. We also thought it would be important to broaden our asset class capability and broaden our geographic scope beyond Europe. But
So you bought Refinitiv as part of this strategy, but big picture, what do you feel were the most important moves you took to establish this as a business with data at the core?
Well, the acquisition of Refinitiv was a very large part of that. This was the former Thomson Reuters finance and risk business. And again, that took us from being a relatively small player to, in that acquisition, becoming one of the world's leading providers of financial data. We're the number one provider in the world of, for example, real-time data. And so that was the big step, but we have done a number of smaller transactions since then. We have invested an enormous amount in improving our data machine, if I can call it that. And that includes functionality with AI. To touch on another topic, we have also struck a number of partnerships, and so it's been a significant journey over the last 4 or 5 years.
So probably the biggest or highest profile of those was a partnership with Microsoft on AI. You did this back in late 2022, and I think a lot of CEOs were still trying to figure out, they were just playing with this, if that. What has that partnership given you so far?
Well, the way you described it there makes it sound as if we had great foresight on AI. I would not make that claim. We did spend a lot of time with Microsoft for about a year and a half before that, and it was about bringing together their technology capabilities and their global distribution and workflow. We all use Microsoft capabilities in our work, unless you are an unusual or have unusual workflow, and really future-proofing us for that. But that combination of their technology, their functionality, their cloud capacity, with our data, with our analytics, we saw as a very, I think, I don't want to speak for them, but obviously we did this partnership together. We collectively saw as a very attractive way to accelerate what we are doing and what they are doing for the financial sector.
Would you advise people who are trying to figure out the kind of AI future of their data that partnerships with the biggest players in AI are the way to go? There's always a tension there between how much you're surrendering in a partnership.
I think that's a very interesting question. And just to be clear, with respect to our partnership with Microsoft, this is a big, important partnership to us. Microsoft took a 4% stake in us. Scott Guthrie, who is Microsoft's head of cloud and AI, joined our board. And within that construct, we are not exclusive with Microsoft, and they're not exclusive with us. We have what is called a poly-cloud policy, and we work closely.
Sounds like something much more exciting, but yes,
okay. Some people use multi-cloud, some people use poly-cloud. And it's really important to us, but also more important to our customers, that we are serving our customers where they want to be served. So we would never be in a position or put our customers in a position where we would say to them, you have to use a certain cloud provider to access our data.
Right.
We make it available in the way that our customers want to access it.
So what's your favorite example of what this AI enablement has done for LSEG?
I have a number of examples. It goes from what I would almost call now relatively mundane, which is a striking thing to say given how quickly the AI dynamics have shifted. But I would say a lot of companies use AI for customer service now. We have about 2,200 people responding to hundreds of thousands of customer queries, given the massive data that we have, the complexity of some of our analytics. And we have basically created an internal model, large language model, that serves those 2,200 customer service agents with all of our internal documentation in the model. It's made them 50% more efficient.
Right.
And I would expect over the course of the next year or so, we will just expose that internal model directly to our customers. That's an example. I could give you a number of others.
So you're not just dealing with any old data here. This is critical data. People have to be able to trust it. Famously, AI models we worry about hallucinations. What have you had to do to ensure that the data feeding these models is high quality and that what you're getting out of them is as trustworthy as it needs to be?
So this is a critical question for our sector and our customers. And if you look at the accuracy rates of the various models that are out there, they can range from 5 or 10% hallucination rate to, in some cases, much higher. And they've been improving as the technology has been improving. But a 5% hallucination rate in the financial sector is not acceptable. Imagine if an analyst's work was 95% accurate. You're going to be investing billions of dollars on that basis? Absolutely not. So it's mission critical for us, literally, to have validated, verified data that we can provide to inform our customers' models, that they know where that data is coming from. They can basically, it's like having a footnote on every piece of data. And again, a lot of the publicly available models are working and moving in this direction, but a lot of those models are trained on the internet. And there's a lot of good information on the internet, and there's a lot of inaccurate information on the internet. So we train our models based entirely on data that we can validate and verify.
So it's kind of closed circuit.
Yeah.
Right. There are also huge debates about data sovereignty. Nations are putting parameters around where data can be stored. To what extent are you running into those barriers? And how tricky is that making the sort of digital economy? And should we be worrying as much about the flow of data right now as we are about the free flow of physical goods?
So we should be worrying about it, and there's a lot of attention on chips and cars and steel and various other goods, and there's less focus on the free flow of data. But data plays a critical role in global economy and in growth rates. There are, of course, privacy reasons and national security reasons why countries should have a certain element of control over their data. But what is important is to find a balance between those privacy and national security issues and the ability to have free flow of data across borders in a way that serves growth, serves AI, and can be helpful to the economies. Actually, this is a very interesting, I'll say, counter-example to the current narrative around tariffs in the US. In the first Trump administration in 2019, the renegotiation of the USMCA included a very forward-looking digital trade agreement. And the Trump administration also signed a free digital trade agreement with Japan. And so I think we'll see how that plays out in this Trump administration.
But you're hopeful for...
But I think there is meaningful opportunity there. And that's in contrast with what you have seen in some other countries where data sovereignty has been more restrictive. In India, China, France, for example, have all taken very different approaches to that.
So let's end on a global markets question. People have been fretting for some years now about the preeminence, the dominance of US markets and of half a dozen Mag 7 stocks within those markets. Do you think the upheavals of recent weeks fundamentally have any lasting impact on the preeminence of the US in the global markets?
I think what we have seen over the last few weeks is, you used the word upheaval, I think of it more as a rebalancing.
Right.
And when we last spoke in January, I think the US as a percentage of global market cap was 70% or higher. It's still pretty far up there, and that feels overweight.
You're saying it has a long way to fall?
I think, again, this is not a prediction, but I think it would not be unusual for there to be much more of a rebalancing in terms of allocation of capital in the equity markets. You could say the same thing about the value of the dollar. So there's been a lot of discussion about how the dollar value has gone down, I don't know, 9 or 10% in the last couple months. There's a good case to be made, and again, I am not an economist, this is not a forecast, but there is a good case to be made that the dollar is 20% or so overvalued today.
Okay, it's not a prediction, but we'll hold it to you.
Well,
hold you to it when we see you next. So, David, thank you very much.
Thank you very much.
Please welcome Ted Leonsis, founder, chairman, managing partner, and CEO of Monumental Sports and Entertainment, and Max Tawney, media editor at Semaphore.
Ted, thank you so much for being here. This is really great. For those of you guys who don't know, Ted obviously owns Monumental Sports, owner of the Wizards, owner of the Washington Capitals, the Mystics as well as the regional sports network that broadcasts those teams. You guys, one of your teams just had a major passed a monumental milestone. That was obviously Ovechkin passing Gretzky as the all-time scorer leader in the NHL. We got some fans in the audience, which is great. I'm really curious, obviously that's a huge moment for him, huge moment for yourself and the franchise. You drafted him, he's played for the Caps his entire career. I'm curious, what was the conversation like, after he has passed that milestone? What was the conversation like between you guys?
Well, the community, the city, the league, Wayne Gretzky, my family were very grateful, and it shows the power of Washington, D.C., this world's most important city. We should never undervalue that, and we've seen that in the last 100 days. You mentioned our holdings here. We also own Capital One Arena. We've owned it 27, 28 years now. We're in partnership on the go forward with the city. And we hosted the inaugural and also a victory moment for the president. When the new White House was being installed, I wrote a letter, said, I'm not red or blue, I'm red, white, and blue. How can we be in service? And so they took advantage of the building because it's a convener. We can bring 20,000 people there. And to show you the worldwide interest, we were there for 2 days. The president thanked us 4 or 5 times. We hired an agency. What kind of worldwide recognition did we get? And it was 750 billion impressions, $1.75 billion in mentions. Just for those 2 days, the president saying thanks to Ted and Monumental.
Wow.
And did you see Alex Ovechkin? He's got big wrists. When Alex broke the record, it was in Long Island at the Islanders, and it was 850 million impressions for that one day, all talking about Washington, all talking about the hockey team. So these brands, these sports enterprises have really become huge economic brand drivers. They are building. We'll bring, you have 3,000 people here. It's fantastic. We'll have 20,000 people this evening. We bring 3 million people a year into our building for Caps, Wizards, Georgetown, Mystics, concerts, events, and the like. We're one of the largest taxpayers in the community. It was interesting listening to the last speaker on the dollar. I obviously don't agree with that. I would say that we're hugely undervalued, and Washington, D.C. is hugely undervalued. We don't exist, right? We're not a state. And when you look critically, the United States has the debt on its balance sheet. We all know how much money that we have as debt, but our real estate isn't measured. We do not put the 650 million acres that's under the Department of Interior, like the mall, which is right down the street, which attracts 35 million tourists a year in the Washington, D.C. That doesn't exist on anyone's balance sheet. So I think that Washington, D.C. and sports teams and our buildings, our arenas, our real estate, incredibly undervalued.
Well, can I ask, since you've been in that arena for for over 20, almost 30 years, if I'm not mistaken, I'm curious what role you're undergoing this major renovation right now. Just kind of broke ground on that late last year. I'm curious what role you see the arena having in DC and the community now compared to what it was like when you first bought the Caps.
Well, major metro areas have very few defining, iconic businesses and brands. Every city, though, has those. You think of LA, and Hollywood obviously is a defining business, but it's universities, it's a defining business community, it's green space. It's very few things that define it. And sports teams. You close your eyes and you think of Boston, you think of the Celtics, you think of the Bruins, you think of the Red Sox. And here in Washington, D.C., we are a very, very small city. We have 700,000 plus people in Washington, D.C. If we defined ourselves as Washington, D.C., we'd be like Columbus, Ohio. But our media market is very big. It goes from Richmond, Virginia, all the way to Delaware. And we should probably acquire Delaware now, kind of make it a little tuck-in, if you will. And that's a 10 million person market. As a DMA, it's top 5 in the country. And so our building convenes, it brings people in from Maryland and Virginia. More and more, we're bringing in the tourists who come and visit. Cherry blossom time was rocking. DC was rocking with tourists globally, tourists throughout the country, kids on spring break, families coming to DC for the first time. And so we have this miasma, if you will, of people, tourists, students coming here. We have 8 universities. And what's happened really, this is the most educated, most wired, most important community in the world. And so if you're bright and you're college educated and you come to Washington, D.C., I'm a Georgetown graduate, you come to Georgetown, you go to GW, you go to any one of our great schools, you graduate, you want to come and live here. And so this city has really, really become the most educated, most wired. And right now, we have to build businesses, we have to build technologies. Our new arena is going to be the best new arena in the world. We're spending almost $1 billion between the city and us in making it the best building for our players, the best players for our fans, and really one that shines. Tonight's game is on national television, and so it's like a 3-hour infomercial that you want to be able to show the best and the brightest of Washington, D.C. on a worldwide basis.
So Ted, I want to ask,
Do I sound like a cheerleader?
Yeah, just a little bit. So you thought, but it wasn't set in stone that you guys were going to return to Washington. You thought about moving the teams to Virginia. Obviously that didn't happen.
I didn't think about it. I had signed a deal to go.
Yes, you thought quite a bit about it. But obviously you're still here. There was quite a bit of backlash.
And the mayor gets all of the credit.
Well, I'm curious what there are a lot of business leaders in the audience. I'm curious what you personally took away from that saga, and what you think other business leaders can take away from the response to that.
I'll bite my lip on some of the negative lessons, and the positive is that you really loved us. It really mattered, and that I misjudged the move of 3.5 miles to Virginia, or the proposed move, how that was emotionally crushing to people. And I'll never make that mistake again. I've been married for almost 40 years. I love my wife, love my kids, my grandkids, and I should have known better. When I was getting married, my wife, who's I've married above my station, she told me, if I don't trust you, I can't love you. That's genius. And I think I broke trust in saying that we would go. It was a business decision. Let's be honest. Washington, D.C., you can't build up here. Where we're located, I can't build down. It's the metro's underneath, and I can't go up. When you drill down, and why is it again that we can't go up? It was, well, there was Ben Franklin, and he met an architect, and they were trying to convince Washington to become president and not have Philadelphia as the capital. And so he said, well, this guy is doing this for Napoleon. So think about it. Napoleon helped to design France in a way that there wouldn't be guerrilla warfare in the city. That was one of the key design deliverables. And we are still living with that. We can't build high. It's an algorithm, one of the first algorithms. And so when we were going to go to Virginia, there was 70 acres. It was right near the airport. We could do what's very on trend, which is to build an entertainment center around it. Then I hate to say we got lucky, but the mall next door to us went Chapter 11.
Yeah.
And all of a sudden, we had this opportunity working with the mayor to say, well, if we stayed, instead of going up or down, now we could go aside. And we're very fortunate. We'll go from 900,000 feet to 1.6 million feet, and we'll be able to innovate. We'll be able to bring some new offerings, if you will, to the community.
So we're almost out of time here, Ted, but I have to ask you this question because you're the owner of an NBA team, you're on the board of governors, and the biggest story in the NBA was the shock of the Luka Doncic trade to the Lakers, where I'm from in Southern California, which is great for me. But I was curious, as an owner of a team, you wake up and see that, or maybe you're up late and see that. What was your reaction to that moment? And I don't know, what do you make of that? I'm curious from an ownership perspective, what you thought of that moment.
Well, we've had a different experience in the NHL in that we have the most successful franchise in the league, in the world, won the division most times in the 25 years I've owned the team, and we have players that want to stay here, but it all flows from Alex Ovechkin.
Yeah.
And that if you treat the talent, if you will, like their family, and they embrace that, they don't take advantage of it, and you feel like you're in partnership with the player. And I can't tell you how many times people say, well, you should trade Alex Ovechkin. You always trade people too early. And it's like, well, I wouldn't have that conversation with my wife. I hope my wife doesn't have that conversation on me. We're not transactions here. And, we won our first game in overtime, playoff game on Monday night. And Alex Ovechkin scored a goal, had an assist, scored the winning goal in overtime. He looked like he was 25 years old. He's 40. And we are a living proof point that if you do the right things in the right way, you can be successful. You can be sentimental and romantic, but also clinically, analytically, do the right things in the right way. And so, we want to be an exemplar in the leagues. We want to be, by innovating, we want to be an exemplar to the leagues and the culture that we're building with the teams. We want to grow our revenues. We want to grow our revenues because half of the revenues go to the players. We pay taxes. We're very, very important. We might be, in most cities, the defining most important industry. And we're just starting to have that focus and that understanding. I remember I was president of America Online. We were the 6th most valuable company on the New York Stock Exchange at the time. We had a $160 billion market cap, and I bought the hockey team for $85 million. And I was on a panel like this, and I was asked, why would you buy a shitty little hockey team? 25 years later, sadly, AOL doesn't really exist anymore. It's owned by private equity. It was merged with Yahoo. And hockey teams probably value $2.5 billion. My basketball team's probably $4.5 billion. This is a $7-8 billion kind of enterprise with very little debt, right? So they've turned out, if you do the right things in the right way, you make great products, you have great culture, you can have a growth mindset, you can build a lot of value. But you can't build the value with that as the focus. The focus has to be championships, great product, great customer experience.
Well, Ted, unfortunately we're out of time, but thank you so much and good luck tonight.
Great, thank you.
Take care.
Appreciate it.
Please welcome George Walker, CEO of Neuberger Berman, and Liz Hoffman, Business and Finance Editor at Semaphore.
Hi, George.
Hello, Liz.
Thank you for joining us. So Neuberger Berman, giant global asset manager.
Medium size.
500 and something billion at
Medium size.
10:30 this morning. Clients all over the world, investments all over the world. What happened to that American exceptionalism that everyone was just raving about 3 months ago?
Global trade war and extraordinary uncertainty. The dialogue around American exceptionalism can return as and when there's greater certainty with regards to policy.
But, this administration inherited an economy that was growing fairly healthily.
Nicely.
In a bunch of ways, kind of the envy of the world. A lot of countries would have traded for the hand. And here we are. So what do you make of kind of the policy choices that have been made? How far down the road do you think we are in terms of being able to, if the president woke up tomorrow and said, just kidding, walk it back as a CEO, how would you be thinking? How would that reset the way you're sort of planning?
The answer is I don't know, is the honest answer. I don't, it's unclear if you take, the discussions around China from the past 12 hours or 24 hours, are we at 125%? Are we, what we know is it's not going to be 125 and it's not going to be 0, and we'll know soon. So it's a pretty extraordinary. That's a pretty extraordinary range. So it's a challenging, it's a spectacularly challenging period as we're trying to figure out where the administration is going to land the plane.
Ultimately,
And it could. I think it's possible they could land it in a great spot. I was chatting with a former Trump 1 senior official who was making the case. George, this is going to be great. We're going to negotiate our way to lower barriers than existed before all of this uncertainty. And trust me, we're going to land the plane in a great spot. That's one potential scenario. Global trade war is obviously another potential scenario.
ultimately, the White House was paying attention to markets. There was a feedback loop there. It took a little longer, I think, than some people had thought, and the strike price on that option was a bit low. But were you reassured by the fact that there is sort of a feedback loop, and that, in fact, the market has kind of, I think, been the only force that has really, so far, put up much of a fight on policies that they don't like?
Yeah, I don't. I'm not a psychiatrist, so don't understand exactly how the president's thinking and what his motivations are. I do wish he might speculate less. Like the whole discussion around Chair Powell, I think has not been super helpful. The tweets followed then by sort of yesterday's reassurance. So I don't. Perhaps it's the market's reaction to what would, terminating him would have been an unwise policy, may have caused him to pivot. Perhaps it never was on the table. I just don't know if I went back and reread his old book, as many of us have, and one of his standard negotiating tactics is to, quote, aim high, which is where you start and then make concessions.
and that enables people to feel good that they've pulled him down. And so is that what's happening? I'm not sure. So I think we all have to ride through this period of uncertainty, recognize that it is going to cause market declines as we've seen, and as we have clarity and stability of policy, we'll be in a much better place.
The dominant trade right now seems to be sell America, and I'm curious, you have clients all over the world. Have you noticed a change in their willingness to engage with you as an American asset manager, their willingness to invest in American assets? Sort of more broadly, it feels like there's been a vibe shift in kind of America's standing in the world.
I think that's true. You see it. One of my partners was in Canada last week for a conference that was scheduled to be in New York. You see constraints on important Canadian financial institutions in terms of their folks traveling to the U.S. I've had discussions with sovereign wealth fund heads in lots of regions around the world. There's no doubt this period of uncertainty is causing people to reflect and rethink. Can things return to the way they were? Yes, but I do think there's a real cost. Just even asking the question is not helpful. Like going home and asking your spouse, should we get divorced? Even if you 3 days later come back and say, yeah, you know what, I'm all into this marriage, I'm committed, this is great. A year later, that conversation changes things. So I think is there a cost? Absolutely. Will Canadians be booing our national anthem in 2 years' time? I sure hope not.
Have you seen it in your business?
A little bit. We haven't had anyone pull a mandate. We had one unfunded mandate that was put on hold.
That doesn't mean what the DC crowd thinks it means. This is a different kind of unfunded mandate, right?
Oh, yeah, sorry. So we around the edges a little bit, and I think a lot of clients are historically, clients have been way overweight to the U.S., and I think clients are looking further afield now.
Is the Europe is good? Does that have legs? Is that closing a valuation gap that was kind of always there? What's going on there?
I think it could end up being a real positive for Europe that you'll see, particularly in Germany, releasing some of the fiscal constraints that they've operated in. So it could. I think a global trade war benefits no one, but I think Europe on the margin might be more attractive relative to other places until we have clarity.
In addition to running Neuberger, you are on the board of Memorial Sloan Kettering and the Ford Foundation, which I think one of the largest private endowments in the world. What are you doing to prepare for a day when you get the call that says one of these organizations is on a list coming out of the White House? How do you think about that?
I'm a relatively new member of both, and so we'll answer the question not about them specifically, but broadly. I think all hospitals, all research hospitals, and MSK is just an extraordinary research hospital, are grappling with these new government rules with regards to how much of overhead in research, this 15% constraint, which the definition of overhead, these are absolutely real costs. And so I think every operator of a major research-based healthcare institution is trying to figure out how to deal with that. Is it real? Is it permanent? And so that's a large issue. And then I'd say in the not-for-profit world, it's quite hard. If you read the paper today, right, there is speculation that there's a 5 o'clock tonight, there will be executive orders signed. Nobody knows what they are. Well, nobody outside of exactly. A few people do. There's speculation in the philanthropic community that it could be targeting their non-US activities. It could be targeting their DEI efforts. It could be targeting climate change things. It could be challenging tax-exempt status. So it's very hard to plan for because you don't know sort of what it is.
And do you think the donor community broadly is able to fill some of those gaps? I mean, like, you're starting to see a little bit of backbone cropping up in some of these places, and the question is, can they afford to say no to the White House? Is there going to be enough private money to step in on some of that cancer research or those causes that the Ford Foundation has been, or others have been funding that perhaps the administration doesn't like?
I think the federal government plays a huge role in certain things in international aid. Private philanthropy has an important role to play, but it can't fill the whole of the U.S. government. So I think institutions will be wise as giving changes, will be wise to go back and re-underwrite, are they getting the highest ROI for that investment? How can they do the most good with their limited dollars, given this quite significant change in global funding? So in a lot of the stuff the administration is trying to do, some of it, I'm very supportive of. Some of it, I'm less supportive of. How they've done a lot of it is I think challenging for us all. We're more used to rules we understand long before they're implemented and adjusting. And here it's you're in response mode, but it's not clear exactly what you'll be responding to.
I wonder if there isn't a bit of an opportunity here. For the last 10 years, kind of everything went up, setting aside a couple of months around COVID. Particularly in the investing world, it has been a rough stretch for stock pickers, people who say this investment's better than this one. Yep. It was a great decade for people who piggybacked on those decisions and bought the market.
Thank you for framing that
No
that
problem.
way. The free riders.
No problem. Where are we in that sort of, what is the future of active management? And actually, given that the world is really messy, and there seems to be, maybe you can be rewarded for being a little smarter than the next person, how do you think about that?
I think in active, it's a far longer conversation, and we have limited time. In active versus passive, I think most people just look at the S&P. That's a small part of the market, and so active works really well in lots of places around the world, in mid caps and small caps. It's very different than the S&P. In the S&P has also, the Magnificent Seven have sort of wildly skewed those results. So I think it will be a better period for active managers versus the S&P. It's been a good period for active managers in some other places. I think the important thing from a policy perspective is we all still haven't figured out stewardship. As passive grows, when I started, less than 5% of the industry to now 55% of the industry. And as they pull back from engagement, given political pressures, like who's going to play the role of owner? Who is going to have the tough conversations with CEOs and boards saying, you can do better, let's talk about capital allocation and other things. We're moving to a strange place where no one in public markets is engaged as you would want them to be engaged as an owner. And I think large asset owners are going to have to figure out how they want to address that.
Is Neuberger going to stay in the engagement game?
Yeah, it's a huge part of what behaving like an owner, being deeply engaged is a huge part of what we view our responsibility. About a third of our firm is stock picking. About a third of our firm is bonds, and about a third of our firm is private stuff. But engagement is incredibly important to us.
Well, listen, thank you so much. What an interesting chat. Appreciate it.
Thank you.
Please welcome Valdis Dombrovskis, EU Commissioner for Economy and Productivity, and Ben Smith, co-founder and editor-in-chief of Semaphore.
Well, nice to see you all again, and thank you so much for joining us, Commissioner. You're the former trade commissioner. Your new role is over across European Union finances. You were at the Latvian Central Bank. You were the Prime Minister of Latvia. A lot of experience in this space. You said this morning, I think, that it's hard. What is happening with the trade talks right now is hard for Europe, and it's harder for the United States. Does that mean in this negotiation that time is basically on your side, that Trump's hand is getting weaker?
First of all, as regards tariffs, indeed, we see them as economically counterproductive, leaving negative economic impact both on the EU, but even more so on the US economy. So we have done some simulations. Of course, they depend very much on scenarios chosen amidst this very large uncertainty concerning trade policy, but to give some ideas, so we estimate a negative economic impact on EU economy at 0.2% this year and next, whereas on US economy at 0.8% this year and 1.3% next year. And negative impact on world economy somewhere in a range 0.406%. So therefore, from the EU side, we are engaging with the US administration, trying to find solutions to avoid this negative scenario and find a mutually acceptable solution.
But in some crude sense, if it is worse for the US and giving us more pain in these negotiations, doesn't that mean that in some sense you can afford more to wait? Are you looking at it that way or no?
First of all, it's worth noting that right now we have this 90 days pause when Trump at least partially suspended its quote-unquote reciprocal tariffs. And from our side, we have also suspended our first set of counter tariffs. So this is a window of opportunity to negotiate right now, because we had been very clear that our preference is to find a negotiated solution. We have put forward also some concrete proposals, like purchasing more US LNG, cooperating in generally more in area of energy, also proposal on zero for industrial goods, and so on. So we are trying to find a solution and way forward. But we have also indicated that in absence of solution, we are ready to defend our companies, our workers, and to come with countermeasures. Those countermeasures are currently suspended, so we need to use this window of 90 days.
Do you feel you've gotten clear signals from United States negotiators of what they want?
That's exactly the issue, that more clarity would be wished there, because this engagement obviously requires clarity from both sides. From our side, as I was mentioning, we had already put forward some concrete proposals and certainly are ready to discuss.
So they say they're negotiating, but there are no proposals?
Well, currently, indeed, one would wish for a more clarity on expectations on US side.
Do you feel at a higher level that you sort of personally have clarity about what Trump wants? Does he want a zero for zero free trade regime? Does he want all manufacturing here? I think we don't really know. Do you feel you know?
What we know is the negative economic effect of the tariffs, and that is what we want to avoid. And that's why we came with different proposals, including zero for zero. So far, we haven't got any positive feedback on this proposal.
This is a very question about Washington now, but do you feel that the people you are talking to, like Jameson Greer, are talking to Trump? Do you think that they actually represent the U.S. government? Can you tell?
First of all, it's worth noting that I'm not the trade negotiator.
I know, I'm sorry, we'll get to the economy
quickly. I'm not talking
quickly.
Also directly with
yes, your former role.
Yes, exactly. So it's I used to be trade commissioner in previous European Commission, so now it's my successor, Maroš Šefčovič, who is more engaged in those talks. So my direct counterpart from that point of view is Scott
Besant, but I'm noting that he is now being more involved in those trade negotiations as well.
Ursula von der Leyen said recently that the EU is open for business, that in their talks, obviously, with Latin America and elsewhere. Is the EU open for business with China?
As regards China, we share a number of US concerns on industrial overcapacity, on China's non-market policies and practices. So we are ready also to discuss with United States how to best address those issues. Actually, we had a good platform for engagement in previous mandates, the EU-US Trade and Technology Council, and we have flagged also the Trump administration that we would find it useful to continue with this or similar format also looking forward. It allowed us also to address many questions related to China, but also much broader set of questions. Well, as regards EU policy towards China, we had been formulating it as a way of de-risking, but not decoupling. China is, by the way, our second largest trading partner after the US. So we obviously continue this engagement with China, but there are also certain strategic dependencies which we need to address. For example, in area of rare earths, where there are certain rare earths or critical minerals where China is dominating the global supply chain, and those are the areas where we need to de-risk and to diversify our relationship.
There is some concern that as if the U.S. remains in a trade war with China, that you'll see cheap Chinese products flood Europe, and that they'll sort of provoke further deindustrialization in Europe. Are you worried about that?
Indeed, this is obviously the concern, because with U.S. market close to Chinese goods, the question is where all those goods and where all this industrial overcapacity will go. And a lot will depend also how China will react to this situation. Will it act as a responsible global citizen and will be able to find a way forward? But obviously, if we'll see dumping of those goods in European market, we'll have to react and protect our market, as we, by the way, have recently done with Chinese battery electrical vehicles.
Is President von der Leyen going to travel to China this quarter?
Well, I cannot now announce specific travel plans of the president. It's for her to announce those travel plans.
But would you anticipate a trip soon?
As you know, generally speaking, we are engaged with China, and generally speaking, we aim to diversify our trade relationships with various partners around the world. Especially in a current more uncertain situation. So that's why we recently concluded the trade agreement with Mercosur, modernized our agreement with Mexico, with Switzerland. We are negotiating trade agreements with a number of countries, India, Indonesia, amongst others. Just a few weeks ago, we started negotiations with United Arab Emirates and so on and so forth, because we also see that diversification is part of this response. EU has already the largest network of trade agreements around the world, but we are seeking to further expand and deepen those relationships.
On the question of China, obviously the trade war with the US is the second most important war happening in Europe right now. And China, has supported Russia, or at least through its war in Ukraine. To what degree is China's role in that war linked to Europe's willingness to trade with them? Do you think that there's a possibility for China to play a constructive role to pull Russia back?
Certainly China has lots of leverage in this regard, and if it wanted to be more active in containing Russia's aggression, it certainly had quite a few levers to do so. But in reality, we saw China taking quite ambiguous position in this Russia's aggression against Ukraine, and this is something we had indicated also to our Chinese counterparts.
given that this is essential security threat for entire Europe, because it's not only Russia's aggression against Ukraine. Russia is openly talking about invading other countries, about restoring empire, and so on and so forth.
So will that be linked to trade talks?
Well, in any case, that is linked to our overall political and economical relations.
I mean, do you think that as the U.S. maybe steps away from Russia, from negotiations between Russia and Ukraine, that there's a Chinese role there?
What we think that first and foremost, there cannot be negotiations about peace in Ukraine without Ukraine. So obviously Ukraine has to be in a driving seat. And second, that we need to achieve a just and lasting peace. Not just some kind of peace which allows Russia to regroup, to restock, and to continue its aggressive wars either in Ukraine or against other countries.
And this is, in the time we have left, this is, audience includes a lot of people considering investing in Europe. Part of your mandate now is simplification. Can you quickly persuade people that this time Europe is serious about becoming more investable effectively and following the Draghi recommendations? Well,
first of all, already now we see that our stability and predictability, respect for the rule of law is already proving a strength. And we have...
compared to the US?
And we have, well, I would say globally, and we already now have a stronger investor interest in euro-denominated assets. That's something we are seeing already now. We obviously need to leverage our single market, which is our largest economic asset, so the market of 450 million consumers. So we need to address remaining barriers in a single market. And obviously, cutting red tape and bureaucracy is part of this overall work to strengthen Europe's competitiveness, and already we started with very ambitious proposals in terms of burden reduction as regards sustainability reporting, and we will be following it with new proposals in different areas across the entire European Commission mandate.
Well, that was fascinating and very careful. Thank you for
thank you.
Thank you for taking the time.
Thank you.
Please welcome Carlos Cuerpo, Minister of Economy, Trade and Business of Spain, and Alexis Aquaguirre, Managing Editor of Semaphore Africa.
Thank you very much for that very kind introduction. Carlos, I'm delighted to be here talking to you. I mean, for those of you who are not aware, this is quite the moment for Spain in terms of the fact that the IMF has predicted that Spain will be the major advanced economy that's the fastest growing this year. And
for
that's
the second year in a row.
Yeah, you beat me to it. And then as well as that, Spain was responsible for nearly 50% of the economic growth seen in the Eurozone. Yeah. So, I mean, obviously, what could go wrong? There is a lot going on at the moment. So the first thing I wanted to ask you was, what are you doing to manage the possible impact of just this volatility that we're seeing at this moment in time?
That's a great question. I think it's good that we started by putting the figures down so that we know that Spain is actually the only major economy that had its forecast revised upwards yesterday by the WEO, by the IMF. And it's actually on the back of a very strong growth momentum. That's actually what we've seen in Spain for the past few years. As you said, we're outgrowing the euro area. We're 10% in terms of size, but we are contributing 50% to euro area growth. And of course, exposure to the US is maybe less significant than other euro area countries, 5% direct exposure of our exports, but still indirect effects are still there. And at a sectoral level, a few sectors are highly exposed to the US. So,
such as,
for example, pharma, such as cars as well, such as some in the agri sector, wine, olive oil, and others, steel as well. So in a sense, we know that we need to get ready for that. And coming back to your question, barely 24 hours, no, 12 hours after the press conference by President Trump on the setting up of the tariffs, of the general tariffs, we already had a plan, a response plan on the table to protect our firms and our workers. So basically getting a grab of all our financial instruments and our trade instruments to protect our companies.
And is there anything else that you're doing to get ready? I mean, that was the plan then, but this is a very dynamic situation. Yes. I mean, what else are you looking to do?
Well, now basically we're following up on a daily basis on to get a gauge of the impact. We need to know exactly what's going on and to what extent our firms are already having or feeling the impact of the tariffs that are in place. Let's not forget that there is a window of opportunity for negotiation with this 90 days period of pause for part of the tariffs. But to a great extent, there are tariffs already affecting our companies, plus the additional element of trade deviation that can also affect Europe and also Spain. So we are in a monitoring phase to see whether or not we need to actually upgrade our current response and the extent of the financial instruments and of the potential also specific direct subsidies to companies that are mostly affected.
And I mean, one thing that's been notable is the effect that it's had in terms of Europe cleaving together. That, you know, nations that maybe had taken different stances have come together as a bloc. I mean, what approach would you like to see European policymakers take in terms of their response?
Well, as you said it, I think this is one of the benefits of the current situation, that Europe is really rallying around a unified approach and response, because we know that as separate member states or countries, we have less strength when it comes to negotiate a fair and balanced trade deal with the US or other partners. So we need the strength of the scale of the force of the whole European Union, which is 450 million consumers. That's what we need, and therefore we need to rally behind the European Commission. The Commissioner was here before, so that basically they feel that they have their own, the full support of member states, and they can negotiate, as I said, a fair deal.
And where does this leave the EU's relationship with other nations? I mean, China specifically. I mean, what happens there?
Well, there is an element here. If Europe wants to be a grown-up in the new world order that is actually being redefined as we speak, we need to, of course, engage with the main economic powers in the world, and we need to also try to extend the network of strategic allies. We're doing that, for example, with Mercosur, with Latin America. Hopefully, the deal between the EU and Mercosur will be ratified before the end of the year. That's a great step for Europe, and particularly for Spain, as you know, which is a bridge between the European Union and Latin America. But also, we're extending that network to other countries in Asia. And with respect to China, coming back to your question, we know that China is a rival, is a competitor in many areas, but it has to be also a strategic ally to the extent possible. There is a huge deficit in terms of trade with respect to China. We need to open up that market. We need to also attract investments from China within, of course, the economic security agenda that we have in Europe, protecting our firms or companies, but we need to engage with Chinese authorities.
I want to follow up on something that you mentioned. There was a fleck of it there. You referred essentially to Spain being a kind of bridge. So you're looking very outward facing. One thing that I've noticed is that Spain, at a time when other advanced economies, the US and UK most notably, are talking about cutting development aid, development assistance, Spain has been quite vocal about a desire to do the opposite and say that there needs to be a way to shore this up. But do you have any innovative solutions, any ideas as to how to do this?
Well, we've been pushing actually for the last few years to try and find innovative solutions, for example, on ways to rechannel the special drawing rights. There is a huge pool there of money that can be used for development, that can be used for these global public goods. And we've been finding solutions within the IMF, for example, with the creation of the Resilience and Sustainability Trust. We also last year found a bridge between the World Bank and the IMF to be able to, within that trust, actually fund projects that are World Bank projects, so that we can use Euro area SDRs that can only be channeled to the IMF for World Bank projects. So there are, of course, ways to look somehow out of the usual comfort zone to go ahead and and fill the gap in terms of financing development. And we're still, we were the first country to pledge to rechannel 50% of our SDRs. And we will reach that 50% goal this year, this month actually, with an additional disbursement of $1.9 billion US dollars to the Poverty Reduction and Growth Trust of the IMF. So basically, again, fighting these against poverty in the most vulnerable countries, especially in Africa.
Is this a new disbursement?
Yes.
Okay. And are you calling on other countries to do this? Because obviously Spain can't act in isolation.
Yes. Well, we've been doing this, extending this call to other countries for the past meetings, both the annual and the spring meetings last year. And we can even go further, actually. We're ready to further engage in rechanneling up to 60% of our special drawing rights, another extra 1 billion euros, but we need also to find the instruments to rechannel these for the best of purposes. And also, when you were thinking about, or you were asking about other initiatives, Spain this year, in 2025, will be hosting the International Conference for Financing for Development in Sevilla, end of June, early July. And that's where we want also to basically make a call to everyone that this is not the time to go back on financing for development. To the contrary, actually, we're really far away from the development goals that we did set for ourselves for 2030.
But why? I mean, why do you see the need to do this? Because, I mean, fundamentally, ideologically, this is a different way of looking at things. And other countries are saying, look, we need to be inward-facing, and there isn't a need to do this. Where do you see the value in this?
Well, I think there are two elements. So this is part of the DNA of the current government in Spain, but it's very aligned with the citizenship. I think this element of actually going ahead with this multilateral view, with this element of financing for development, that comes, or that is very entrenched in the Spanish society. And then there are additional elements, of course, related to the specific security concerns. For example, when it comes to Africa, there is the element of migration and the different routes that come from the particularly West Africa.
You mean via the Canary Islands?
Exactly. So there is a specific effort there coming from Spain to foster development in those countries to avoid that particularly the youngsters have to take the hard route to come to Europe.
So, I mean, to be clear, I'm the managing editor for Semaphore Africa, so I'm particularly interested in the Africa perspective here. I mean, what initiatives are you talking about when you say, yes, we're going to do this in Africa?
So
any specifics you can point to?
So, for example, for Sevilla, let me just be quick and give you 3 examples on how we plan to go ahead. For Sevilla, what we want is, aside, of course, from having the statements and declarations, which are important because that gives a political signal and willingness, we want concrete deliverables. So one of them will be what we call debt pause alliance. So basically, not only public creditors, but also private creditors engaging or committing to include these debt pause clauses in the loans that they sign with vulnerable countries, so that when there is a specific event, such as a famine, such as a health crisis, or a climate event, then they can pause the interest payments, and then they can devote those revenues to actually get out of those crises without turning this liquidity issue into a solvency problem. That's one particular element that we'll be pushing for, to include more countries, to push also the private sector to go ahead with these clauses going forward in their loan contracts. And there's another one which is related to the debt swaps. We're working together with the World Bank to have a debt swap hub, basically where all the current experiences in terms of debt swaps for vulnerable countries can be put together, best practices, also capacity development, technical assistance there, so that we can get into more countries, both debtors and creditors, engaging also with the private sector into these particularly important instruments and fiscal space freeing solutions. And then the third element is one that we started with Senegal, which is what we call Forward Alliance for Africa. So basically what we want is to further develop or create economic development, as I said, in the countries that are the origin of these big migration flows for Europe and for Spain particularly.
So that's Senegal, and where else? Gambia?
Senegal, which is the first pilot case, and then Mauritania as well, Gambia. So there are a few countries that will be part of the initiative, but we are trying to launch the first pilot with Senegal, basically aligning their interests, their own agenda. They have their 2050 agenda, and aligning that with the main stakeholders that will be investing, not only private sector, but multilaterals as well, and somehow trying to put all the necessary layers for economic development at home.
And are these Spanish companies that would be involved?
Mm-hmm.
Yes.
Yes. So there is the element of the private sector actually kicking in and getting into those specific projects. And there are, for example, there's one project related to the creation of a high-speed network of connectivity via Spanish satellite company, Hispasat, that will prove actually essential, for example, for telemedicine or for long-distance education, which are elements that are particularly important in a country that somehow is also scattered throughout the whole geography.
And the last question that I just quickly want to ask.
Sorry, I'm very long in
this. No, I do want to get to this. There's the consideration of 100% tax for non-EU people purchasing property in Spain. What's the thinking behind that, in a nutshell?
Well, the thinking is that not only in Spain, but also in other Euro or EU countries, there is a big challenge with respect to access to housing, and particularly affordable housing, and particularly for youngsters. So what we saw is that in some specific areas, the impact of purchases from non-euro area residents actually was having a toll in terms of increase in prices. In areas, for example, in the southern coast, in some cities like Marbella, for example, the non-euro area residents were affecting up to 8 to 10% of total transactions on a yearly basis. So this was having an actual impact.
So making it unaffordable for locals.
Exactly. Yes.
So is this something that the government plans to go ahead with?
Yes, of course, we are planning to go ahead with it because now it's a time to really reduce those constraints, and what we hope is that once everything will be settled and will be set up again, and there will be an increase in supply, which is another area where we're working on, then we can release these restrictions, these constraints. But up to now, there is somehow the greater good which is providing for affordable housing for Spaniards.
Excellent. Carlos, I'd love to talk all day, but we're pushed for time, so I have to end it there. Thank you so much for your time, and please thank me. Join me in thanking him. Don't thank me, thank him. Okay, thank you.
Please welcome John Rogers, founder, chairman, co-CEO, and chief investment officer at Ariel Investments, Tony Yoseloff, managing partner and chief investment officer at Davidson Kempner, and Liz Hoffman, business and finance editor at Semaphore.
Thank you both for joining us. We'll start with a little bit of a kind of a markets lightning round. You've both been around a lot of cycles. Does this feel like 2020, 2008, 2000, 94, something else? Like, does it feel like anything you've seen before, John?
Well, I go back to 1987, so I've been through.
Okay.
That's
not a great one.
Yeah, the stock market down 22% in one day, and that was just a horrific experience. It has a lot of similarities where you feel the fear wherever you go. People are talking about the markets, telling you they're getting out of the markets, they're going to be more cautious and conservative. So that sounds very, very similar and feels very similar. The angst in the morning, watching and wondering what's going to happen that day. I just think the difference is this time is somewhat, you realize one person can change it all overnight, and that's the part that's unusual and very unique.
Yeah. I would say, so I started my investing career in 98. I would say we're in the late 90s, early 2000s. So a combination of higher interest rate environment like you had in that era. Inflation really hadn't been fully tamed by the early 1990s. You had whiffs of that as well. And just like we have geopolitical conflict today, we had geopolitical conflict in the early 2000s as well with the Iraq War and Iraq War I in the early 1990s. So and then also, I would say excess valuation in tech markets and kind of a long bubble bursting, and there might be some of that in the markets today too.
If we are heading into a recession for purposes of this question, and you each have a blank check, you can only buy one asset, one investment, what would you buy?
Well, there's one investment, my favorite stock that I think will do well in any kind of economy is Madison Square Garden Entertainment. Yeah. If you watched the Knicks game the other day, the stadium is full and people were excited to be there, and all the stars and season ticket holders and suite holders. I think they'll do well. If the Knicks and Rangers are winning, it won't matter what the economy's doing.
Okay.
Well, I was going to say, as a 25-year Brooklyn Nets franchise season ticket holder, I'm not sure about that one. But no, look, without giving maybe a specific name, we really like how opportunistic credit assets can weather a storm. So you might be talking about buying debt at 60 or 70 cents on the dollar. You know, often in an upside case, you get paid par. In a downside case, you might take control of the asset, and that might be really interesting in itself. And so we tend to get protective and to go more into credit type assets in these environments.
Sticking with your experience in credit, distressed credit, there's more of a discussion now about how creditworthy is the United States government as a borrower. Obviously, a bunch of bouncing around in the bond market, some concerns about that. If you were, buying a credit default swap on the U.S. government, you think about 3 months, 6 months, 12 months. Not so much that it's going to stop paying its bills, but that there are going to be more questions around its creditworthiness. How do you think about that?
Well, I think there are going to be more questions around our creditworthiness, and I'm not sure it's just related to the fiscal deficits that we've had, that people are at least starting to talk about. I'm not going to say there's been as much of a fight against it as there could be, but certainly starting to talk about. Look, I happen to have been overseas right after April 2nd, and for the first time, I was getting asked questions about the U.S. government's intentions by international related investors. So, I mean, there's a confidence game to all of this, and the U.S. has been the reserve currency for a very long period of time, but we have not been the reserve currency forever. There's not a guarantee we're going to stay the world's reserve currency. The benefit of the reserve currency is you can keep printing money and fight your way out of any problem, but again, I wouldn't say that's guaranteed forever. So the good news is it's not obvious as a second alternative now compared to the U.S., and I think that's been part of it. But as a proud American, I hope we don't take it for granted.
But when you look I think what this administration is trying to do in certain ways is actually look at the national balance sheet a little bit, right? And say, where are the assets? Where's the equity? We got a lot of debt. We know where that is. How do you sort of monetize parts of the balance sheet? Just as someone who in the credit world, it's all about, what's the collateral? Where are the assets? When you start to think about it, does it make sense to look at a national balance sheet that way? I'll start with John.
Well, I think that, I had friends who were high up in the Obama administration, people who were involved with all the economic policy, and they often said that the assets were not really accommodated for appropriately. You think about all of our assets, whether it's our Grand Canyon or the White House or just so many things that are out there that are a part of our nation that really don't get counted. And it's sort of, when you think about it, the value of those assets have grown and compounded over the years. And if you ever did sell them or find a way to monetize them, it could have a meaningfully positive impact on our debt.
But should we? Should we sell the Grand Canyon to the highest bidder?
I'm sure there are a lot. I don't know about the Grand Canyon specifically. I've flown over it once, I think. But I think there are a lot of assets like that we probably could find a way to privatize. In Chicago, we've done a lot of privatization. Some of it worked, some of it didn't. Parking meters didn't work, but our Skyway was phenomenally successful. As we know, there's lots of ways you can sponsor things and name things. I know we have Ken Griffin coming up, and our Science Industry Museum is named after Ken Griffin because of his enormous generosity to our city. Well, just think about it. We have Buckingham Fountain in the middle of our city. You've got Lake Michigan. What would be the value if you had
Lake Ellison,
right.
Lake Musk? Is this where this ends?
It could be.
Tony, what do you think? You're a credit guy.
I'll give a slightly different answer. I don't think government credit is a balance sheet story. I think it's a cash flow story, and so I think you need to look at stats of like debt to GDP, how much of the operating budget of the government is taken up with debt service. We obviously have other very large entitlements that we pay out as the U.S. government, which are kind of harder to move around. I mean, when you see debt restructurings of governments, and so whether it's like the city of Detroit or Puerto Rico, they tend to look around what's the actual debt service that the entity can support, and how do you reorganize your debt or push out your debt to service that. And then sometimes you wind up with situations where creditors get things where the better the health of the finances of the reorganized city, the better they're going to do. So like Argentina did that, for example, many years ago, and people did very well in that stuff. I don't see the U.S. ever monetizing something like the Grand Canyon, but I will say that just because a government owns assets doesn't mean the government is always the right owner of those assets. I mean, obviously national treasures we are going to always want to keep, but there might be office buildings or other things that we own that quite frankly might be better off in the hands of third parties, and sometimes there's lands that the private sector can do things for that's good for everybody. So I don't think it's a crazy exercise to look and see what we have that's not being maybe utilized to its fullest tilt compared to the private sector. That's going on in New York with stuff like Governor's Island, where it's owned by the city, but they're trying to figure out ways to make sure it maximizes its potential. But I don't view those really as related necessarily. I mean, ultimately, we're operating under the full faith and credit of the U.S. government, and I think that's what's the most important part.
Yeah. But one idea seems to be sort of the Mar-a-Lago Accord idea that's floating around a little bit, where we ask creditors, other countries, we'll take their short-term government debt and we'll give them kind of forever bonds. And if a borrower came to you, a corporate borrower came to you and said, we don't actually want to pay the bonds that are due next month, but we're going to take those and we're going to give you bonds that are due never. Wouldn't that terrify creditors?
Well, so in our world, that's called an LME, which is a liability management exercise, and it's considered a selective default, right?
It is a way of
that
saying
is considered a
D
default, like the government has impacted its debt. So yeah, I mean, it doesn't terrify creditors in high yield markets because people have gotten used to it, because 90% of the debt in high yield markets has little or no covenants in it at this point, but it's not considered a good thing. I actually do think that the U.S. government terming out some of its debt is a really good thing, but it has to be done on a voluntary basis, not on an involuntary basis.
John, what do you think?
I think that sounds right. You're the expert in that area, but I do recall, when the S&P downgraded the United States, it didn't really make sense when you again looked at all the assets of our great nation. The fear that took over during that period was not appropriate.
Ariel has been around for a long time and talked, before it was a thing really, about impact investing, investing with purpose. In addition to its excellent returns, I think in part has been known for being led by two of the most senior Black people in finance, yourself and Melody. I'm curious, have you changed either sort of how you've invested around ESG or really how you've talked about it, how you found that investors of your own and other stakeholders want to engage with that topic, or even just the phrase?
Well, I think that there's obviously a lot of pressure right now around these issues, but our values are still the same, and we believe it's good for shareholders to think about these things in the right way. There's lots of examples of, we all know things that are going on in the regulatory environment, that the problems and trouble you can get into with your company if you are not really respecting the regulatory environment that you're in. And so the risks sometimes the companies have taken by not, following the rules effectively. We help the small and mid-sized companies that we invest in to make sure they're ahead of the curve so they won't get nasty surprises that could impact their balance sheet. We also, of course, are well known, as you suggest with Melody Hobson, of pushing for diversity in management and diversity on boards. And I think it makes sense that I'm a part of the University of Chicago family, and the late President Bob Zimmer would always say, when you're searching everywhere for great ideas and getting different people to come in with different perspectives, you make better decisions. And of course, coming from Chicago, Reverend Jackson often talks about how baseball became a better sport when Jackie Robinson started to play, and Willie Mays started to play, and Hank Aaron and Ernie Banks started to play. The sport became greater, and they all went to the Hall of Fame. They all won World Series, except our poor Ernie Banks. But these were excellent players who were not allowed to play. They were talented in 1940 and 1935, but they didn't have a chance to get on the playing field. So I think if you search everywhere for talent, there is talent everywhere, and it will make your team stronger when you just don't look at people that you're comfortable and familiar with, but when you stretch out and look for talent every place.
When you talk to a lot of CEOs, are they changing the way they are approaching diverse talent, or are they just not talking about it? They've taken it off their website.
I think most companies are still working on it and focused on it. I mean, there's some management teams that probably never believed in it, and this has been an excuse for them to drop it and move on. But I think most people understand that, their customers are also becoming more diverse. The young employees are becoming more diverse. They realize that they're going to be a with it company. They've got to see this and do it the right way. I tell the companies we invest in, if you look like a 1940s company in the 21st century, it's hard for us to invest with you. So I think management teams get it for the most part, and they realize the lawyers are telling them that they have to change. And it's interesting to me, Donald Trump doesn't like lawyers, but he's making them all very rich these days.
Well, in the lawyer capital of America, they thank you down here. You both actually have interesting side jobs, and John, sticking with you for a second, you're on the board of Nike, which got just absolutely walloped that on Liberation Day. I think it was down 15%. Understanding that Elliot runs the company day to day, but as part of the board, trying to plan long term, have a sense of where this is going. Supply chains are incredibly complicated. They have now been scrambled twice in 5 years. Nike was actually early kind of to diversify away from China, went to Vietnam, and then bam. So maybe you can give a little perspective on sort of how you think as a director about sort of setting long-term trajectories for businesses that are pretty capital intensive, pretty labor intensive, pretty hard to move around.
I think we can't talk specifically about the earnings of Nike, but I would just say that Phil Knight created an extraordinary culture and values that are still there. The people are so competitive, so dynamic, so committed to winning. It comes from Phil Knight directly. He also put together an extraordinarily great board. When you think about it, on the one hand, you have Tim Cook, as a lead director, but up until he passed away, the late John Thompson, the coach at Georgetown, was on the board. Who does that? Goes out and searches for that kind of talent, and people who are making sure that we take all of these challenges seriously and have the best governance possible to make sure we have the right leadership at the right time to keep us a great, great company. So I'm totally confident and comfortable in the values and culture there will bring us back to winning again and doing extraordinarily well. And the swoosh is such a magical brand. I'm a true believer.
Tony, you're you're an alumni of Princeton and are a trustee in the endowment there. Your president has been pretty outspoken that he's not going to knuckle under, and I'm curious if you're heartened by Harvard's moves, sort of where you see this discussion going.
Look, I'm a very strong believer in academic freedom. And I think that the public-private partnership between the universities in this country, and by the way, the best universities in this country are typically the best universities in the world, and how they work together to produce leading cutting-edge research, whether it's in the medical field or it's in the climate field or in many other fields, has been super helpful for both the U.S. government and for universities over a very long period of time. And so it's very disappointing to me that this is being used as a bludgeon, and I'm not speaking specifically towards Princeton, I'm just making this as like a general a statement in terms of trying to offset cutting edge research. And by the way, the repercussions of that may not be known for years, but could be massive in terms of what happens if professors who are doing cutting edge things lose out on this. The MNRA technology was invented at the University of Pennsylvania, right? What would have happened if that hadn't gotten funding because of something or other, right? What would have happened during COVID? So we're very supportive of what Chris is saying. He's been on a couple of different news publications, both in print and on podcasts, speaking about this. And I think it's really important that we protect academic freedom and on a bigger level, just to protect these jewels that I think are the envy of the world in terms of the research and the teachings that they're able to do. It's why we have so many international students coming to these universities in the US, because it's the best and brightest in the world who want to attend them, not just in the United States.
But I think there's going to be an announcement on some very hazy at the moment executive order this evening on endowments. And it's not hard for me to imagine a bit of a nightmare scenario where you end up with those foreign students who are, mostly pay full freight, being sort of perhaps not allowed to come. There's some DHS rumblings on that, where you have tax exempt status being challenged, where you have some of the endowment investments themselves, perhaps things in China or other things the government doesn't like. At the same time, you have this big funding gap. And I don't know, I'm curious, when you look at this investment fund that you're a steward of, that's going to have to fund the university and probably be called on to write a bigger check than it used to, like, what do you do?
Well, I mean, so you may know more about this order coming tonight than I do. So I guess we'll see what.
I don't think anyone knows much about this order coming tonight.
What actually comes out of that. I mean, one of the things I've learned, because I sit in the board of a major hospital as well, which also has relationships with 2 large medical schools in New York City. Each university has its own funding model. They've got their own asset funding model and their own liability funding model. So first of all, while many schools have most or all of their international students pay full freight, that's not necessarily the case at all schools. There certainly are some schools, Princeton would be included in this, that provide scholarships for international students as well. There are some schools, particularly those who have large medical schools attached to them, where the government accounts for a significant portion of their operating revenue. It could be 40 or 50%. There are other schools, Princeton does not have any professional schools along those regards, where government funding is actually quite a small portion of it, because it's just not necessarily where funding is coming from. And then you mentioned endowments, and it's definitely true. I mean, I think one of the things that's really up for debate out there is what used to be called the Swenson model or the Yale model, which was basically take on as much illiquidity as possible in your endowment, because you're going to earn the highest returns that way. Like, that whole proposition in my mind is like in question, not because of anything the Trump administration is doing, because the markets have spoken and markets are efficient, and it turns out that private assets are not inherently required to earn a higher rate of return than public assets. Sometimes public assets might actually earn a higher rate of return if everyone's chasing private assets at the same time. So I do think each of these schools has their own mix of how much of their budget comes from the endowment, how much of their budget comes from the government, what do they have to do. There are some that are in better or worse shape for it. I think it's not a one-size-all-fits answer, but I come back to the general proposition that this university research system we have in this country is literally the best in the world, and it would be a shame if we disrupted that.
I would just add quickly that that's all very, very important. I think it gets discussed you discussed it very, very well, described it very well. I think the thing that's also missing is, in a place like Chicago, the University of Chicago employs thousands and thousands of people, and huge jobs, nurses at the hospital, the teachers, the professors, all the people that are there that are part of that ecosystem. All the people who stay in Chicago and become professors and the like because they love the institution. We got DePaul, we have Loyola, we have Northwestern. These are anchor institutions in our urban cities. And so if they fail because of this attack, it's going to have a profound impact on unemployment and the ability for people to have working wages and be successful in their urban communities. So I think that's a big, important challenge that we have to address here also.
Yeah, we'll be looking at the April unemployment numbers very closely, I think, because March didn't tell us all that much. Listen, that's all the time we have. Thank you both so much, and thanks everyone for coming.
Please welcome Ken Griffin, CEO of Citadel, and Gina Chan, Senior Editor at Semaphore.
Thank you, Ken, for being here and for being a co-chair of our event. So we really appreciate it. Lots of things going on since the new president took over, and we're approaching his first 100 days. I wanted to get your sense of sort of the big picture of the policy changes we've seen so far, and kind of your assessment of how it's going.
So it's many of us in business, you look at a new employee, you go, what will they accomplish in the first 100 days? I don't think anybody's ever seen something like this in 100 days.
Is that good or bad?
So it's let's be clear, I think it's mixed. And I think, in fairness to the president, he has an extremely extensive agenda and a very finite amount of time in which to implement said agenda. So if you look at the pace out of the gate, whether it was immigration or working to address the fraud and waste in government, the speed of action has been something that we've never seen in American history. Now, of course, with that speed comes the opportunity for missteps. And I think we've seen some of those also, but there's been some real wins. I think everyone in this room agrees that the United States has been a huge beneficiary of immigration from around the world for its quarter of a century of existence. Huge beneficiary. But on the other side, the chaos at the southern border does not represent an immigration policy. And the president forcefully ended that chaos. And the American voters, that was a really big issue for the American voters. So that was a big win. The pushback on the overreach of wokeism, I can't tell you how many forms we were asked to fill out that went into diversity, equity, inclusion over the last few years. The pushback on that's been, I think, a big win in the eyes of many from this administration. But now we're in phase two. We're in a set of economic policies. And this has been a pretty tumultuous couple of weeks because we've had a shock to the world about America's commitment to multilateralism, to free trade, and we've had a real calling into question the American role when it comes to global security. And that's been a real shock to the world.
So what do you think is different this time from his first term? Because his first term, he also talked about, balancing trade and being for free trade for America. We saw a lot of tariffs imposed at that time too, but it didn't cause, this kind of market volatility, at least, for the duration that it's gone on. And we haven't seen this kind of reaction from CEOs as well.
Well, let's be clear. The United States embraced free trade post-World War II. And one of the reasons that we embraced free trade was to help accelerate economic growth, in particular in Europe and frankly around the world. The United States was so fortunate. Our manufacturing base so incredibly strong, our economy so strong. We really stood in a completely different position than every other country in the world. And with the clarity of thought that there was a potential rivalry between us and the Soviet Union to emerge, the United States really wanted to integrate, and in particular the Marshall Plan, Western Europe, into our strength. And so how do we encourage very strong ties with as many countries as possible? And to the extent that the United States disproportionately paid for global security or allowed entry into our markets that was not reciprocated, we had a tolerance for this because of the privileged economic position that we've had. Now, President Trump makes a very good point that the United States is no longer in such a singular and unique position. And it's time that the rest of the world pay its fair share of the cost of maintaining the global security and world order. Just in rough numbers, the United States per capita GDP is roughly twice that of Europe. It's not quite that high, but it's roughly twice. And the Europe contribution to defense as a percent of GDP is roughly half of that of the United States. Sure. Is it really fair that the average American household's paying 4 times what the household is paying in France or Belgium for security in NATO?
Yeah. So you support his push for those countries to pay more?
So I think the president's spot on right. It's time that our allies pay more of the bill. Now, here's where the president and I differ. We differ in our choice of solution. We would differ in our choice of how we would engage with our allies. Now, I think President Trump has an incredibly good sense of where problems lie, but I think we're moving too quickly, we're moving too haphazardly, and we're breaking a lot of glass and trying to solve some very real problems.
So the administration has said that short-term pain is worth it for what will be gained in the end in terms of, onshoring manufacturing, more jobs here, more things being made here. What do you think the end result of all of these changes will be?
Well, there's a couple of different things here to think about that are just worthy touching on quickly, and I'm going to move quickly. Number one, FT had a great survey just a few days ago. 80% of Americans believe that America would be better with more manufacturing. And there's no doubt a romantic idealism about manufacturing in America. Like, we're humans, we innately want to build things, right? That's how we leave our mark on this world. Now, of note, only 20% of Americans who were in the same survey said they would prefer to work in manufacturing than their current job. All right, Dave Chappelle roughly said, I'd rather wear Nikes than make Nikes.
Yeah.
And that really does sum up where we stand as a country.
The American dream is to wear them.
I want to wear them.
Yeah.
Yes. So the big picture is, one of the points that is made is that the United States has had a strong currency. A strong currency has made it more difficult for American manufacturers to compete. But a strong currency and a low cost to borrow also gives us huge assets, gives us the ability to borrow vast sums of money that we could thoughtfully use to improve K through 12 and higher education, that we could thoughtfully use, for example, to cross the digital divide and to bring internet access to every household in the United States. It's like I played soccer when I was in high school, all right? I wasn't the best at putting the ball in the back of the net. I didn't play forward. I played midfield. I played to my strengths. Our country should play to its strengths. And one of the strengths the United States has had since World War II is globally, America is the country that the world trusts and relies upon. It gives us our reserve currency status. It gives us access to borrowing money at a far lower rate than any other country in the world enjoys for all practical purposes. And we need to use that asset to find ways to strengthen our country.
So, you talked about how the dollar is the reserve currency. Treasuries have been a safe haven. We've seen since some of the tariffs have been announced, on top of the president saying, implying he could fire the Federal Reserve Chair Jerome Powell, though he's walked that back. The markets are, obviously not liking what they're hearing. Treasuries, in particular, have seen a lot of volatility and worries about dysfunction in the market. What is that doing to the American brand?
Well, okay, you actually picked exactly the right word. The American brand, right? The United States was more than just a nation. It's a brand. It's a universal brand, whether it's our culture, our financial strength, our military strength. America rose beyond just being a country. It was like an aspiration for most of the world. And we're eroding that brand right now. And if you think of your behavior as a consumer, how many times do you buy a product with a brand on it because you trust that brand? You could buy like a similar dress with no name for less money, but you want the dress that you think is going to not fall apart in 2 weeks. You want the handbag that you think is well made. You want the television that you know that when you turn it on, it's going to work perfectly. You want the car that when you turn the engine on, it's going to run. And when it comes to money management, for example, there are many great American institutions the power of their brand, that they will deliver a fair service at a fair price, that they'll do well by their investors and put their investors' interests first, whether it's a BlackRock or Fidelity. These are global brands of immense power. But in the financial markets, no brand compared to the brand of the U.S. Treasuries. U.S. Treasury market, the strength of the U.S. dollar and the creditworthiness of U.S. Treasuries. No brand came close. We put that brand at risk. And as you and I both know, it can take a very long time to remove the tarnish on a brand. So the president and the Secretary of Treasury and the Secretary of Commerce need to be very thoughtful that when you have a brand, You need to behave in a way that respects that brand, that strengthens that brand. Because when you tarnish that brand, it can be a lifetime to repair the damage that has been done.
Well, so the president's known to like to hang around with CEOs, talk to them, financiers such as yourself. We have a Treasury Secretary who came from that world, Commerce as well. Are they listening to people like you?
I think the most important, so first of all, when it comes to tariff policy, there's a lot of different thoughts on this issue in the room. All right, if I'm in Abu Dhabi with a variety of people in finance, generally speaking, people in that room are opposed to the tariff policies. But a number of people have the president's ear who are very much in favor of the current policies. I think there's room for us to debate what the right policy is. There's room for us to take actions with respect to the right policies. But what's most important is how do we conduct ourselves that we do not diminish the stature of the United States of America? And that is the gravest concern that I have. How does Canada feel about our country today versus 2 months ago? How does Europe feel about the United States today versus 2 months ago? And some people will scream, well, it just doesn't matter. But you know what? It does. And it matters for a very profound reason. The entire Western world's engulfed in a debt crisis. We've lived beyond our means for decades. The debt to GDP in almost every Western country is becoming unsustainable. And what we're seeing now is the leading edge of us having to make some really tough decisions. We've got to reduce the size of government. You see the backlash against DOGE.
Well, I was going to just ask, do you support those efforts?
Of course I do, because it's just arithmetic. We have got to reduce the spending in Washington. We can't both make good on the promises we made to retirees. We can't provide for Medicare and Medicaid and have the waste that we have in the system today. So, you and I can debate Elon's efforts and so on and so forth, but the big picture is we've got to cut spending. We're also going to have to figure out how we're going to have to raise revenues. All right,
well,
it's just math.
So
we're running into a math problem here.
Yeah.
And no one likes that reality. You look at the situation at Harvard. Part of what underpins this is the federal government saying how much money should we be sending to elite institutions? How much should we be subsidizing higher education through a student loan program that has been widely abused and so ineffective that the students don't even want to pay the loans back in many cases?
So you mentioned Harvard. You've been a big donor in the past, but I know you pulled back funding. I think it was last year. What do you make then of the administration's fight with some of these universities?
I think the administration's fight with Harvard parallels, in some sense, the dynamics that we face with other countries. I think the president's spot on that Harvard has room to address some very important and meaningful issues, and they've made progress on many of those issues. For example, upholding the Supreme Court's decision around equity in admissions, trying to ensure that on campus that Jewish students are treated with respect and dignity. To be clear, every student of every race and every religion should be treated with respect and dignity. And that Harvard should encourage in its students and in its environment an exposure to a broad set of ideas. There's little debate that many of the elite Eastern schools, and for that matter, some of the Western schools, have just found themselves engulfed in a very progressive ideology. And there's room for both on campus. When I went to Harvard, and I was exposed to Martin Feldstein on the one hand, who was just a brilliant free market conservative economist, and Larry Summers, who by today's standard would be a conservative economist.
Yeah, exactly.
But who was just a phenomenal professor. And as a student, what you learn is that really good decisions often lie in the middle of extremes in thought and ideology. And students have lost that experience at Harvard. So I agree, again, with the administration's diagnosis of the issue, but I disagree with how we've escalated so quickly, again, an attack on one of America's preeminent brands. What name in higher education in the world is more valued than the name Harvard?
Yeah. Well, so globally, You mentioned you were in Abu Dhabi and you were in China recently as well. Where do you see investors going if they feel like the American brand, the American markets, treasuries are damaged goods?
So investors, the knee-jerk reaction in every moment of financial turmoil is to pull back to your home country.
Yep.
And we're seeing some of that. There's no doubt about that. Now, if the United States is able to continue to pursue a path of thoughtful regulation and really unleashing capitalism within our economy, and that was one of the big promises that I think everybody in the business community thought Trump was going to deliver on.
Yeah.
Right?
Well, they were talking about animal spirits back in January.
Well,
I think.
let's be clear. I kind of felt those spirits.
Yeah.
And I think everybody in this room did. And in some sense, I think the American CEO relished the idea, I have 4 years to focus on my business.
Yeah. Deregulation's coming.
I don't even need deregulation. I just need no continued onslaught of new regulation. Do you know how nice it is to go to work and focus on our growth strategy and our hiring strategy and how we're going to build a better business and not focus on, well, there's 32 pending rules that we have to comply with. And that was from last month.
Yeah.
And that's going to require several hundred people to write systems that will produce reports that will have absolutely no value to anyone whatsoever in the world. So I think all of us were really looking forward to 4 years of having a chance to really grow our businesses. And unfortunately, the trade war, which has devolved into a nonsensical place, means that we're spending time now thinking about supply chains, thinking about strategically how we're going to source goods around the world. And I'll tell you what's not going to happen is people are not going to race to build manufacturing in America. Because with the policy volatility, you actually undermine the very goal you're trying to achieve.
Well, I know we're almost out of time, and some people have to get to some of the other events we have planned, but I did want to ask you before you go, is there any space where you see room for optimism, for opportunities? I mean, you're an investor, you're seeing this volatility, someone's making money somewhere.
So I'm going to make it really clear. From the perspective, if we were Europeans looking at our US assets, we've lost 20% of our value in 4 weeks. Okay? 20%. Like the United States has become, through the, if you use the euro as a reference currency, we become 20% poor in 4 weeks. There's not a lot of money being made in that environment.
Yeah.
Okay, like when the pie is rapidly shrinking, there are very few people who jump for joy. 1 in 1,000, 1 in 10,000, 1 in a million. There's no one who's a winner in that scenario. So the answer is no, there's no great opportunities when the pie is rapidly shrinking. All you're trying to do is tread water and not drown. That's what you're trying to do in an environment like this. And the glimmer of hope is that we see the president, yesterday make it very clear he's going to support the Federal Reserve Chair. We saw Scott Bessent's commentary that we've found ourselves in an unworkable situation with China. I think we're seeing space being created where we have the room to make needed adjustments. And I think the most important thing that the American business leadership can do is to speak with the president and members of the House, the Senate, and the administration calmly, respectfully, and collectively on how we can get to a better place for our country and our economy, and for that matter, for the sake of growth in the Western world.
Well, let's hope we can get there. Ken Griffin, thank you so much. For those of you, I just want to say thank you. For those of you who are staying, which I hope you will, there is lunch outside. For those of you going to our roundtables, there are shuttle buses waiting for you, and we hope you'll join us again this afternoon. Thank you.